Morning, everybody.
Good morning.
I'd like to call to order the meeting of the Federated Retirement and Healthcare Trust Board. And let's see, do roll call. We have all members here except for Trustee Kelleher. Hopefully he'll be coming soon. I'd like to take a moment to recognize new board member Julie Jennings. Welcome, Julie. Congratulations for getting on to the pension board. Would you like to make a couple introductory comments?
Sure. I'll explain a little like who I am. So I've been working for the city for 17 years, and I've worked in parks, PRNS, Parks, Recreation, Neighborhood Services, and basically my background is budget, fiscal. Before being part of the city, I worked in Silicon Valley. And so, 20 years or so in, companies such as Applied Materials, Adobe.com. That's how I ended up here, .com. And I have a bachelor's and master's in economics from San Jose State. So I like numbers. And I'm very interested in the retirement system. I think that, to me, that sounds very interesting and fascinating, so.
All right.
Yeah.
Thank you, Julie. Welcome.
You won't be disappointed.
Yeah, you'll get some of that here.
Yes, well,
All right, then also, Mr. Liederman, would you like to make an introduction too?
Thank you, Mr. Chairman. Members of the board, and staff, I wanted to introduce my partner, Jenny Krangle, who's here with me this morning. Yeah, you know my other colleague, Jeff Rieger, who has worked with me in both boards here for the last several years. Jeff got an offer he couldn't refuse. He's going to become chief counsel of the Alameda County Pension Fund, which is a 37 Act system, and that will start next week. So, Jeff, I wanted to have an opportunity to introduce Jenny to you, and Jenny will be working closely with me as we go forward with your permission, and it will continue to provide guidance to the board on all matters fiduciary. So, Jenny, good morning. The hardest thing was to explain to her how the mics are always on.
Yes. Thank you very much, Mr. Liederman. And Ms. Kringle, would you like to say anything else to introduce yourself?
I can give you just a quick little background. I've been representing public retirement systems for about 15 years. I was in-house at CalPERS for a number of years. Do a lot of tax and fiduciary work and really enjoy this work, very passionate about it, and feel it's important work that we're all doing together.
Great.
So thanks for
No,
having
thank
me.
you, and you're welcome. Okay, I'd like to remind all speakers to speak directly into the microphone. And also, presenters, please clearly state your name for the record and audio recording. I'm going to proceed to orders of the day. We do have a time certain at 10:30. Item 4B, the discussion and action regarding the repayment of the workers' compensation offset for Danny Horning. And then I'd also like to, when we get to item 4A, that's Mr. Hallmark from Cheiron will be taking that item, and I'd like to combine the Cheiron items while Mr. Hallmark is here. So that'll be 4A, the discussion and action on OPEB valuation results, as well as the discussion on Cheiron's 5-year budget projections and the assumptions for 2020 actuarial equivalents. So can I have a motion and a second to approve orders of the day?
I'll make a motion to approve the orders of the day.
A motion by Vice Chair Chandra
Second.
and a second by Trustee Horowitz. All in favor?
Aye.
All opposed? That carries. Also going to ask for a waive on sunshine for item 4B, the discussion and action on regarding the payment of workers' comp for Danny Horning. Is that one required action, motion, and second? Yes. Waiving. So I need a motion and a second to waive sunshine.
If I may, Mr. Chairman.
Yes.
Would you please identify what material is the subject of the waiver? Was something submitted
Yes.
late?
Materials related to Danny Horning's.
All the material was submitted late?
Yes.
Okay,
All of it.
thank you.
And I'll make a motion to waive sunshine.
Okay, motion by Vice Chair Chandra. Second? Second by Trustee Horowitz. Thank you. And all in favor?
Aye.
All opposed? That one carries. Okay, we're going to proceed next to the consent calendar. The consent calendar today includes the approval of service retirements, approval of deferred vested, approval of board minutes, approval of return of contributions, acceptance of communication information reports, approval of travel conference attendance, and that's it. So are there any items to be pulled from the consent calendar?
I'd like to pull item 1.5D.
15D, okay. Anything else? Okay, so can I get a motion and a second to approve the consent calendar with the exception of item 5D, 15D?
Motion to approve.
Okay, motion by trustee Sun. Thank you. Second by trustee Horowitz. Thank you very much. All in favor?
Aye.
All opposed? That one carries. Okay, item 15D.
Yes, thank you, Mr. Chair. Just wanted to call attention, that is the newsletter that was forthcoming for a long time now. This was our first quarterly newsletter. It was issued the second week in January, and we intend to issue the newsletter on a quarterly basis going forward. We have received some good comments from members about the newsletter, and we will actually be mailing the newsletter quarterly for the full year. But in the next few newsletters, we're going to be including a little note to allow members to let us know whether they wanted to either receive the actual newsletter or they prefer to get e-format, so that we don't have to, if they prefer to get it by email, we just rather do that rather than to having to mail all of them. So the goal is to, again, issue them for the rest of the year, allow members to let us know whether they prefer to receive the actual hard copy or not, and then in 2021, then just mail out the ones that people are expecting to receive. And the goal is to have every quarter with a theme. So the next quarter probably is going to be, the theme is going to be actuarial information. And then usually in the summer, we may have investments related. In the spring, in the fall, it was probably going to be the healthcare information, and then come back to January. So we, if you have any comments about the newsletter or you have any input about the newsletter, feel free to let us know so we can make whatever changes are needed. So thank you, Mr. Chair.
Thank you. I like that newsletter. I thought it was well done. You or your ghostwriter did a good job on that. Is that Barbara?
There was a lot of work done by the communications consultant, Barbara and Linda. So I do want to publicly thank
Yes.
Linda and Barbara for the work and the newsletter. And you can't tell right now, but they're really excited about the second one forthcoming in April. So thank you both.
All right.
Just one question. I noticed that this newsletter is for all members, dedicated the whole entire page for profile for the CEO. Just wonder if that profile page is going to be kept down, is going to be continue going. Is there a plan for the profile page?
So we haven't decided that yet. We may decide to go with the profile for everyone in the office as we go and trustees, but that hasn't been decided. I think it will be depending on how much material we have for each quarter, but it's one of the thoughts that we have to have a one page with a profile, yes.
Okay.
Okay. Can I have a motion and a second to accept the 15D ORS's first quarterly newsletter, Retirement Contribution, or Retirement Connection, sorry.
So moved. Second.
Okay, we have a motion by trustee Horowitz and a second by Vice Chair Chandra. Any discussion? All in favor?
Aye.
All opposed? That one carries. Thank you very much. Okay, item 2, death and survivorship notifications. I'd like to ask for a moment of silence for those who've served the city and have since passed. Thank you very much. Okay, moving on to item 3, oral update from the CIO of Retirement Services, Mr. Palani.
Thank you, Mr. Chairman. So you may recall that the mayor has a task force called the Retirement Working Group to address issues surrounding our pension obligations. And at the December meeting, originally, I was asked to present on fees, and that got bumped to January, and now it's got bumped to February. And so we will be making the same presentation, but in February. But it gives me a chance to actually make this presentation before your board prior to that meeting, and Laura will join me in making that presentation. So it's my expectation that Trustee Chandra and Trustee Sunzeri will also be making the presentation with us at the next meeting. So there are 2 attachments here, and I'm not going to go over both attachments. The second one, item 2, City Council fee presentation, was actually made to the City Council back in October, I believe. And that's the same format that we use in front of the City Council every year. And just to note here that we actually produce the most comprehensive fee report out there. I believe there's only 2 or 3 of our peers who actually have present fees at this level of detail. But more importantly, since we keep talking about fees, I really wanted to go back, have an open mind and say, have we added, have our managers added value over and above fees? And so I asked Laura and Makita to go as far back as possible in history and say, let's go back and look at the data. And let's pull out as much data as we can and see whether managers have, over time, added value or not, active managers. Because the question is really, you have a choice here. You can either passively manage your portfolio, or you can use active managers, which produces fees. Now, the passive side too, there are fees, but they're much smaller than active managers. So Makita did a phenomenal job of going back for over 10 years, actually. Now, on a 3-year basis, and we will talk about those numbers in a little bit, if you go back 3 years, we actually have tracked all managers. So we have the complete list of managers, current active managers, as well as terminated managers. On a manager-by-manager basis, we can actually see whether they've added value or not. But on a 10-year basis, we don't have that kind of data. But there is a way of finding out, even for 10 years, even without the granular manager-level data, to see whether managers have added value or not. And ultimately, does this really make a difference to our funding ratio? Right? That's really the point here, because we're trying to improve our funding ratio. So I'm going to pull up the first presentation and go to slide 3. And after this, Laura will make the remainder of the presentation. This is a very simple slide, but it's a very important slide. So let's assume we have the option to invest $100, and we have 2 managers, one passive, the 2 columns on the left, and one active, which is the 2 columns on the right. And let's assume that the manager produces a 10% return. So we start with $100, and at the end of the year one, we have $110. And let's just assume for a moment that this is a passive manager who will actually manage our fund without any fees. So at the end of the first year, we have $110, a 10% gain. Now let's take an active manager who actually charges a 1% fee, manager 2 here in this case. Now, if the manager produces 11% return, and therefore the 100 grows to $111, and then you take off the $1, you're still left with $110 at the end of the year. So as long as a manager produces value over and above the benchmark that's equal to the fees, then we've been compensated for the fee that we paid. I know this is a very simple chart, but I just wanted to put it out there so everyone understands. So fees matter only if our active managers don't pay us back for the fees that we pay them. Otherwise, it can be a wash, or they could have added value over and above the fees. And that's the question that we're trying to answer, looking at the data going back in history.
Can I make a comment?
Sure.
I think if you're just looking for a wash, and then you're actually not paying attention to some hidden fees or hidden cost, I think for active manager, what we are really looking at is better payoff above the additional fees.
Yeah.
Because if you have an active manager, we have much more higher cost internally for due diligence,
Right.
right? So that's the part I just want to point out.
Yeah, this is just an example to show that if you add $1 worth of value over and above the benchmark, it compensates for the fees. If you add $2,
Yeah.
then you've paid yourself one more. So I can add another column if you want that shows manager who's added $1 and a manager who's added $2.
No, that's not my point. I think you're trying to say as long as we get a wash or better, we are.
Well, we're not even talking about risk here, right?
We're not talking about
There's,
risk
There's
yet.
also many positives on the risk side.
That's
Right?
correct.
So it's not just hidden fees. You should also take into account risk. We're not even talking risk here because there's sound reasons to have active managers because they could be risk controlled, right? So in our comprehensive fee report, which is the second attachment, we actually have operating costs in there as well, not just fees. But this is a very simple chart, as I said, and I don't mean to talk down to anyone, but this is important to understand this concept, right? Because we keep talking about fees when the board should really be focusing on asset allocation. And that's the point I'm trying to make to all stakeholders, right?
Comment? This is a question, Prabhu, for the good of the board. Private managers, active managers, are compensated by both management fees and carried interest. That is an interest in the upside profits of the fund.
That's right, yeah,
When you refer to fees,
yeah.
are you including both as their fees? And could you explain the difference between
Yeah.
them as to whether one, the carried interest is of the same nature of a fee as the management fee?
Yeah, no, great question, Harvey. Thanks for that question. So if you look at our second attachment, which we presented to the City Council, we show both what we call the base fee as well as a performance fee. So Harvey referred to performance fees. So certain managers are compensated with the performance fees. And now that's the norm in private markets, but there are also occasionally public equity managers who are also compensated based on a performance fee. And what that is really, what it means is there's usually a hurdle. In the case of a public manager, it could simply be a benchmark. And as long as the manager matches the benchmark, all they get is the base fee. But when the manager performs better than a benchmark, then they're incentivized to do better. And then there's a profit sharing element, which is a performance fee. And for example, a standard performance fee, we call this in the business a 2 and 20. So a 2% base fee and a 20% incentive fee for the value added over and above the benchmark. And in my opinion, I think it's good practice to have performance fees because then the managers and our plan are aligned, our interests are aligned, And in fact, even with our public managers, to the extent possible, when we talk to an active manager, a prospective active manager, one of the questions that I have for them is, are you open to a performance fee arrangement? And where they can lower the base fee and offer a performance fee. Then they're incentivized to do better than the performance fees. So when we actually talk about fees, we actually include both fees when we talk to the council. So Laura is waiting to talk about all the work that she's done and Makita has done over the Christmas break. So take it away, Laura.
Good morning, members. I'm Laura Wyrick from Makita Investment Group. It's nice to meet you, Trustee Jennings. So if you take a look at slide 4, one way that we can look at whether or not active managers have added value is by comparing the actual returns of the plans to an investable benchmark portfolio. This benchmark is something that you see in all of your quarterly performance reports, and it's outlined in your investment policy statement as well. And the way that the investable benchmark portfolio is calculated is by taking each target asset class and a passive benchmark for that asset class. So for US equity, for global equity, it would be the MSCI All Country World Index investable benchmark. So if you take a look here, the 10-year, and we looked at 2 10-year periods, there's a lot of endpoint bias whenever you look at one single point in time. We've had a 10-year run in capital markets that's been an incredible risk-on bull market. So we are looking at these numbers, at the end of that time. We also wanted to look at the end of 2018, where you had the fourth quarter of 2018 being down quite a bit. So we looked at two different market environments as we could get in the recent past, even though we've had mostly one market environment for a long time now. And you can see here that the Federated City Employees Retirement System returned 5.4% on average per year for the 10 years ended September 30 of 2019. That's higher than the investable benchmark portfolio, which is made up of passive indexes weighted at the targets that have been adopted by the board. If you look at the 10 years ended 12/31/18, which encompasses that very down quarter at the end of 2018, you see an even return with the investable benchmark portfolio. One thing to note is that this investable benchmark portfolio is calculated using target allocations. The plan's not always invested at its target allocations for a variety of reasons, one of which might be private markets. It's very difficult. It takes a long period of time to invest in a diversified manner to get up to your target in private markets. Just a caveat I wanted to mention. So then we looked, I'll skip slide 5 since it's just a graphical representation of what I just mentioned.
Well, can I get a back on that? You were saying
Sure.
using target allocation. Isn't that the investable benchmark using the actual allocation to calculate? So that's not target, right?
There's a policy benchmark that is purely targets. The investable benchmark is using the actual allocation, but in the case of private markets, it's not, the actual allocation is much lower than your target.
Yeah, I get that. So when you calculate the investable benchmark, are you using actual allocation or a target?
We're using the actual, which.
So for your
yeah.
private sector, so that discussion regarding the difference between the target allocation is moot point at this, for this.
It applies
for this
to
table.
certain asset classes like private markets, where there's, say, the Cambridge Associates private equity benchmark, but we might invest those funds that are waiting to be invested in private markets in the Russell 3000 index, for example. So there's some minor differences for the investable benchmark beyond just your actual.
Okay, thank you.
And to follow up on that point a little bit, the fund's actual asset allocation has varied greatly over the past 10 years.
Yes.
So is this based on our current allocation or the meandering allocations that have existed over the course of 10 years?
It's based on the meandering allocations that have existed.
Okay, so the benchmark calculation, A, is pretty complex.
That's right.
But what we're not seeing is compared to something else like a simple 60/40 portfolio that may give us a more consistent benchmark across the 10 years.
You can definitely look at 60/40. The portfolio is invested very differently than a 60/40 over this time period.
Right, but I think when people raise questions about the expense ratio and our expenses, they are thinking about whether or not our overall performance is better or worse than something that could be done that's much simpler and less costly. So I think that would be a very relevant comparison point, as well as the benchmark portfolio that was constructed here.
So if I could just add, is there a particular way or benchmark methodology that you guys have in mind? I think because the traditional, I think, maybe I should say traditional, perhaps the practice is to take the data, the investable benchmark data that's available, and try to create a rationale methodology that makes sense. So what they're saying is that they're using existing data benchmarks. They're not setting it at 60/40, but they're adjusting it over time to be the best replication. Any other series of benchmark calculations could be used as well, but we're kind of using common practice. But I guess I'm posing the question, which is if there's some other way that makes more sense, that's more clear, helpful, we could explore it.
Yeah, I think what I'd mentioned too is, if you're talking about whether or not the asset allocation made sense, comparing it to a 60/40 probably makes a lot of sense. I think the goal of this presentation was to determine whether or not active managers have detracted fees. And so I think in that case, it makes sense to look at the benchmarks that these managers are using.
Yeah, from my perspective, we set asset allocation. Now, did we do better or worse with active managers within that? Our choice to be non-60/40 has a lot to do with risk, and that's a lot to, so I actually think the comparison to 60/40 is a red herring, right? Either we choose to be a 60/40 plan and take on all the risks, which this plan was unwilling to do before I got here because people were freaked out by the great financial crisis and destroyed a lot of potential asset, funded status. That has nothing to do with a fees discussion, in my opinion. Those are two different conversations.
Yeah, I agree with Trustee Chandra, and I think what Trustee Horowitz is talking about is really comparing, if I can sort of, 60/40 versus the investable benchmark, and therefore going back and saying, did we have the right asset allocation or not? Did we need such a complicated asset allocation and invest in private markets? Could we have just done a 60/40? But this exercise, as Laura pointed out, is merely to find out whether our active managers added value and did we get compensated for the fees. But that is a great point that you raise about did our asset allocation make sense? I mean, we can second guess what the boards did 10 years ago. That's a moot point. But going forward, we can certainly talk about the relevance of that. And in fact, we don't have the chart here. We often compare ourselves to the public plan universe, right, of our peers, and we say, oh, we've underperformed a lot of our public plan peers, and why is that? And that's one of the reasons is that our equity beta in our benchmarks has been lower than our public plan. In fact, we've been at the bottom quartile over this time period in terms of equity exposure.
Okay, thank you.
So slide 6 shows you how, one of the things I think the city in particular and this retirement working group that this presentation will go to is concerned with is how the funded ratio and their contributions might change if you weren't paying active management fees. So we looked at how the actual funded ratio would respond, with the actual portfolio value. The funded ratio as of the end of September is 50.7. If it had been invested at the investable benchmark, it would be 49.2. So it has had an improved funded ratio over the investable benchmark value. Page 7, if you want to take a look, I think the active versus passive discussion is really important. And some folks on the city council or other stakeholders might not realize how much the plans actually have in passive investments, which is much higher than peers. If you take a look at the Federated plan as of the end of last year, the passive percentage was over half of the plan at 56%. So this is all low cost, replicating an index passive exposure. When we look at peers, it depends on whether you're looking at public plans and what size, but we see closer to about a third of most public plans passively invested. So certainly much higher for the San Jose City plans. Then we wanted to dig into the actual data on page 8. So we have, every number for the last 3 years in terms of managers that have been hired and been terminated and exactly how much value is added after subtracting fees over each manager's benchmark. Of course, we're looking at one point in time here. We wouldn't expect every manager at one single endpoint to have added value. Some of these managers were hired to control risk and perform differently in, say, a down market environment, which we haven't experienced recently. So, if all of these numbers were positive, we'd expect that in other market environments, they might all be negative, which is not an outcome that we want. And then in some asset classes, there aren't really reasonable passive options. If we want to get access in the plan to the different types of risks that are in, say, high yield bonds, emerging market debt, private markets as a whole, you can't get that exposure through just investing in an index. We're constantly evaluating new products that come out that attempt to do that, but there aren't really a lot of great options for, say, emerging market debt that aren't paying huge transaction costs and taxes in different countries and that sort of thing. So if you take a look, the Federated managers here, current and terminated, over the last 3 years have added $13.7 million in value to the plan after fees were paid. On the police and fire side, that was 14.5%. And then we wanted to look at private markets as well. So if you take a look at page 9, we looked at, you can see the bottom 3 bolded lines here are for the Federated City Employees Retirement System. We looked at private equity, private real estate, and hedge funds net of fees, compared them all to public markets indexes here, and all of them have outperformed over the 3-year time period. There's 2 private markets asset classes that aren't on this slide. One is private debt, and the other is real assets. As you know, investing in private assets, it takes a while to reach returns in partnerships that you subscribe to. You commit capital, and then it's called over time. It's invested usually over, say, a 3 to 5 year period. So funds that are brand new or within their first few years don't realize returns yet. So the returns that you've experienced in real assets and private debt are positive. Those are just young programs, and so it doesn't make sense to judge them based on their returns yet. With that, I wanted to skip ahead a bit. I won't go through every slide, to slide 15, which is in the appendix. And I really wanted to highlight the extreme measures, I would say, that the staff and the advisors go to when it is decided that it makes sense to implement an allocation through an active manager. Fees are a huge focus of the staff and the advisors. And so, already you can see here the median asset class fees and what San Jose is paying. Also, beyond even getting fees that are lower than the asset class fees, the staff really goes to great lengths to negotiate fees whenever an active manager is used. So we estimate that the retirement plans save an estimated $2.5 million per year based on the fees that they've negotiated with investment managers relative to whatever the rack rate is. So not only are they looking at managers that already charge less than what the median is for the asset class, but then they're negotiating beyond that as well.
So you compared this to the quote rack rate, but do we have any information about what other plans are actually paying? Is anyone paying the rack rate?
We have information, so originally we had a column in here showing what each manager was actually charging, not what the asset class median fee was. And for confidentiality reasons, we were asked to remove it as a public document because the managers don't all want everyone to know how much you're paying relative to their other clients.
Yeah, I would just add to that. In many cases, we are price takers because we are a $6 billion plan. If we are CalPERS or CalSTRS, we'd have a lot more leverage over managers, but we still try.
Mr. Lieberman?
Do we enjoy better fees because we can invest with our sister fund, the police and fire? And has that borne out?
Yes, I think size does play a matter. I wish I had 300 billion in assets, but even, between 3 and 6, it makes a difference. And the more you can invest, the lower the fees are. And it also helps that sometimes it will be a Makita recommended manager, and Makita will get favorable fees because it's not just San Jose, but there are other pension plans that are also in the same strategy. So Makita will get a fee break because of, the aggregate assets invested.
I I think the San Jose plans have also developed a reputation for the staff being very fee sensitive and pushing on that. You know, we'll get calls from investment managers that are interested in bidding on a search that will say, should we even try? Because we know that we can't come down further. It's a capacity constraint strategy. You know, we know it's such a focus of the staff at San Jose.
I just want to pose a question, maybe something for us to think about. I think this is a very informative presentation about how much value has added by private asset or alternative asset. That only shows us true over the last 3 years or 3 years also we have added value with alternative assets. But in those 3 years, if we take all the portfolio into mind, are the passive managed assets also increase value? What's the difference of increase in value? So we don't really emphasize so much on the alternative assets. I mean, I do see a value in alternative asset, private equity, in terms of risk controls, probably adding more opportunity for us to earn extra additional earnings. But I don't want us to lose sight that there's a much bigger portion of the portfolio are invested in passive assets. So we should look at the opportunity cost between those two assets to see are alternative assets adding more value to the portfolio than the passive managed assets. That's all I want to say.
So we will be making this presentation to the City Council. Again, my message to the City Council is stop looking at fees. If you want to improve our funded ratio, there's, as Bill will say, there's only 2 ways to increase our funded ratio. Either you increase your contribution to it, or you increase returns. And you're not going to increase returns by focusing on fees, clearly. And you look at the 10-year history, and our funded ratio would not be different. Focus on asset allocation. That is the single most important factor that drives returns. And your board will have a chance to discuss asset allocation in a couple of months. So, thank you.
I'd like to say something.
Yeah.
You were mentioning in comparison to other municipalities, our allocation towards the passive is much higher. So who are you comparing to, and what are their ratios like?
They vary widely. So the most recent survey by the National Association of State Retirement Plans, which is a body that gathers a lot of, there's a lot of states that have pension plans that are not much larger than San Jose's or some California counties. I believe there were about 180 because there's, a lot of states have, say, City of Phoenix will have a police and fire as well and whatnot. It includes other public plans that aren't just state plans. So I think there's about 180 plans, and the percent passive was between 30 and 40%, which has come up a huge amount over, the time period that they've been doing this survey, because everyone is getting the same pressures that you all are to move more to passive.
And so do you see why we're increasing more towards the passive versus?
Yeah, I mean, it's certainly to save on fees. I think Makita Investment Group and the San Jose staff have similar opinions on the fact that you shouldn't be paying active manager fees for beta, for what you can get in the market. If you're going to pay active manager fees, you want to do it in an asset class where the investment manager has an ability to really add value in excess of their fees, and there's some track record. So an asset class that has a much wider dispersion of manager returns is usually a less efficient asset class where you might want to consider going active. An asset class like investment grade bonds has a very tight dispersion of returns. So even if you hire the best manager in that asset class, the amount that they'll add over fees is likely to be low. So we try to focus on going active in asset classes where the manager might have an opportunity to add outsized value. Or control risk, which was another point. It might be decided that it's a pretty risky asset class, and so there's certain asset classes like emerging markets bonds where the index has a huge weight in some country that you wouldn't necessarily want a huge weight in. So by hiring a manager that can be more diversified, it makes more sense for the plan.
And in full disclosure, our passive assets may actually come down a little, because one of the reasons why it's also high is because we have a pacing plan for private markets. And so it takes, when you make an allocation to private assets like private equity, it takes a while to actually fully deploy those assets. So every year, we actually invest a certain percent of the allocation because it's hard for the market to absorb that, and we also want vintage year diversification. So what is not invested actively in private assets is usually placed in an index fund.
I see.
So over time, the percent of passive will come down slightly.
And we're moving more towards the private,
Well, we already have made an allocation,
right?
and that allocation then takes time to actually deploy.
Okay,
So the boards have already approved that, but there's a pacing plan to do it.
I see.
And not to go too far down memory lane, but when the city did sort of ask the plans to de-risk, there's different ways that you can try to de-risk a plan. And the board and the staff at the time opted to invest more in hedge funds, which are less risky than equities, but are active. I think the board now and the staff has moved, the board's adopted an asset allocation where if we want to control risk, let's use low-cost fixed income and cash equivalents that are, inexpensive and can be invested passively instead of something like hedge funds to be lower risk.
And just a point of clarification, so when the chart showing the amount of passive versus active, I presume that's based on today's allocation, and over the past 10 years, which we were looking at, again, that also meandered greatly. Were we much higher in active over the course of the 10 years?
That's right.
Okay, so have we looked at a chart of what our history is, active versus passive,
We can
over the course
certainly
of
pull
10?
one together.
It'll be interesting to me. Thank you.
Might help.
And then
Trustee Sun, yeah. Go
Okay,
ahead.
regarding fees, I think I want to make a comment. The CIO seemed to point out like all the city staff and then, and members of the plan seem to pay extremely attention to fees. I want to make a point. I'm thinking everybody's a fee conscious, but ultimately we're watching for the bottom line. The portfolio has not been performing up, at the level where the members have expected to see. That's why the fee becomes a huge issue. And then in the past few years, the fees had been pretty high. And I've seen in one of the presentations you have shown the fees is under control, it's trending downwards a little bit. So it's really a positive sign. But to put the fee completely on the side, saying we shouldn't pay attention to fee at all, that's just not going to stay well with all members. I think, if, of course, if the performance of the portfolio improves over the time, the fee will attract less and less attention.
You're absolutely right, Trustee Sun, that had we been in the top quartile, nobody would be looking at fees. Because we're in the bottom quartile, people are looking at fees. But as a representative of your beneficiaries, I hope you'll point out to them that you should really be looking at funded ratio and what are the ways of improving funded ratio. And that is not by looking at fees. That is by focusing your attention on asset allocation. And so as a CFA and as somebody with investment experience, I hope that you will also take this message to your beneficiaries that we need to increase our funded ratio. Our conversations should be surrounding asset allocation. We should be focused on asset allocation, right? Not constantly talking about fees, because every time I go in front of the council, I'm talking about fees, right? And that's draining our energy, and we are focusing on the wrong thing, right? And even if our fees have been high over the last 10 years, clearly you could see that we've done better than the investable policy benchmark. Therefore, what we've done wrong, it's Monday morning quarterbacking, and I can always go back and second guess what prior boards and staff have done, that our equity beta was low. But at least going forward, let us have more informed discussions about how to increase our funded ratio, right? And we are very conscious of fees, as you guys are, and as Makita pointed out, our staff are very conscious of fees, right? And I constantly talk to them about what are we paying our managers, why do we have an active manager here, could we do this passively, right? So I'm not saying that it should be hidden under the carpet. That's on the contrary, we have the most comprehensive, transparent fee report out there. But I'm just trying to say we should reshape the debate. We should take it into the direction of what we've done wrong. And again, I'm second guessing, and it's easy for me to sit here and say this because we didn't do this collectively. But in hindsight, the plans would have been better off. We didn't know in 2010 that we'll be in the start of a big bull market, right, for the next 10 years. Had we known that, we could have been 70-30 and gone home. But we didn't know that. But we should really be focusing on asset allocation because that really drives returns for the plans.
Do you have a recommendation for the asset allocation?
We will be making a few recommendations in 2 months, and the boards will get a chance to pick our Makita and staff will work on asset allocation. Yeah.
And since Prabhu came on as CIO, the plan has been, increasing equity a bit, decreasing the hedge funds, has made a lot of changes on asset allocation already, and we'll continue to talk about it.
So just to confirm, that's the March meeting?
We are
We
expecting.
just finished our capital market assumptions for 2020, and that's sort of the start of, it was this week, so now we'll put together what the plan's current allocation looks like using those updated assumptions as well as some other analysis and bring it to the board.
I think I just want to comment on the conversation at the working group the other week, which I thought was really helpful. We did some scenario analysis and said, what if we had an incremental $20 million or $30 million? And if you were there, Julie. So even if you put $50 million or incremental $100 million.
Could you take a step back and just, because I know some people weren't there at that meeting.
Yeah, sorry. So there's a retirement working group with a representation of various diverse stakeholders and having a discussion around the plan, its unfunded status to a degree, and what areas should we really focus on and think about in terms of priorities? What could we be doing differently? And also helps to inform the board and provide additional perspective. So as Prabhu just said, and we know our role is to really focus on asset allocation. The conversation, the topic segued at this meeting to the scenario of if you had an extra $50 million every year, or it was actually a $20 million example, but it doesn't matter if you use 20, 50, or $100 million. You still don't materially impact the unfunded liability to the extent as quickly.
100 million was good.
Yeah,
Every
as much as we
It
would
was
like.
3 years,
As we
4
would like.
years.
So if you think about that perspective, if somebody just dropped a big bag of money into the
Yeah.
center of the room, that amount has to be so large that it puts the conversation around the management fees as if the management fees are immaterial, which I'm not saying they are, but it's all about relative size. So I want to just highlight that for everyone as a reset, that we care about this multi-billion unfunded liability. I've said my piece, thank you.
And just so I can understand, so that was based on assuming the continued asset allocation would continue, but with the extra $100 million.
Yes, I think so.
It was assuming
Well,
that six
yeah.
and 3/4 assumed rate of return.
Yeah. Well, just to give some context.
Just based on the discount rate.
Yeah,
I see.
so what the mayor was talking about, and I guess Bill can address this, that
Sorry to
there
pull you in there,
there is
Bill.
there is a potential additional revenue source for the city of 10 million. And so the mayor was just sort of
Well, 20 million.
hypothetically, or 20 million,
20.
maybe between
They were
both
gonna
plans.
split it between
between
police
the
and
plans.
fire. Yeah.
What if we actually turned it towards, increased contributions to the pension plans? Would it make a difference? And Bill pointed out that, with the $3 billion unfunded liability, 10 million per plan
Saved
won't
us
really
3
move
years.
the needle, yeah.
It saved us 3 years.
We'll take 100 every year, though, an additional
100
100.
Yeah, I think that was the main takeaway from that was combining the plans, there's a $3.5 billion unfunded liability. And so if you're adding an additional 20 million each year, when you put it on the graph, it's hard to see. It doesn't make a big difference for a while. It certainly helps, but it's not going to just solve the problem overnight just because of the scale difference. And so I think that same issue is coming up here in this discussion.
Okay, Mr. Palani, anything else for CIO update?
That'll be all, Mr. Chairman. Thank you.
I appreciate you doing that, and I thought it was a great preview because the questions and comments and clarifications that were raised by trustees here today may be relevant, and I appreciate, Laura, you writing the notes down. I saw that, and, yeah, that's very helpful.
Come back with an active, passive OPEB.
Yeah, yes, great, that's great. Okay. Next, item 4, old business. 4A, discussion and action on the OPEB valuation results as of June 30, 2019 by Cheiron. And again, we're going to, per orders of the day, we're going to take 4A, 5D, and 5E all together.
I'm Bill Hallmark with Cheiron, and I've got Mike Shunning with me to talk about the OPEB valuation results. The OPEB plan, we talked about the assumptions last month, but just as a reminder, it's a primarily closed plan. There is a small piece that's ongoing. And so this chart at the bottom shows our projection of the benefit payments out for the remainder of the closed plan. And so you can see, even though it's closed, those benefit payments extend a long time into the future. So this valuation develops the city's contribution for 2021. We use it to project future contributions and for accounting disclosures. And just like with the pension plan, the explicit subsidy portion of the, thank you.
Can you start over?
Start over. Just like with the pension plan, the explicit subsidy portion of the OPEB plan, which is the premium subsidy in retirement, is funded through a 115 trust. And so we've got the contributions going in from the employees in the city and investment returns in the trust. And we accumulate those and then pay out the benefits and expenses. The one thing that's different on the OPEB side is the employee contributions are fixed at 7.5% of pay. So there's no adjustment to those contributions. They're just set. And so we calculate a total contribution, subtract the employee contribution, and that's the city contribution. Now, the implicit subsidy portion, which is the portion of the retiree claims that is above the premiums charged for each plan, is paid by the city as a part of their active health premiums. So the active health premiums actually become somewhat inflated to cover the costs of the retiree implicit subsidy. So we don't pre-fund that portion, but it's something that's tracked in the valuation. We have to report it on financial statements. And so you'll see in our valuation report, there's a column for the implicit subsidy that shows no assets, but so you can see the total liability for retiree medical benefits. But this board is really just focused on funding the explicit subsidy portion of the benefits. These are charts that we use commonly both for the pension and the OPEB plans. The left side shows the contributions for 2020 and 2021. The purple bar is the member contribution. The gold bar is the city's contribution, and then that light blue at the top is the implicit subsidy amount. You can see between the years, contributions are going down slightly, about 0.8 million for the city. The decline in the member contribution is just a decline in payroll for those still eligible for the benefit. So it's really a decline in the number of people who are still active employees and contributing to the plan. We were just talking about the size and relevance, so before I go too much further, I want to point out that the entire contribution here for the city for this plan is 21 million, compared to, for the Federated pension plan, the city's contribution's 191 million. So this is a much smaller plan, much smaller piece than what we're looking at on the pension plan.
Can I just ask clarification? This is contribution for the benefits or for this is the overall just contribution of?
This is the contribution that goes into the trust to pre-fund the benefits.
And when you're saying benefits, you're talking just the health care?
Just the healthcare
Okay.
benefits.
All right, because you were talking about that, but then you were talking about what we pay overall, so I was getting a little
Yeah,
confused.
sorry, so these are just for the retiree healthcare benefits.
And so it's going down because the Tier 1 employees are retiring and there's no more coming in, thus the decrease?
The plan is closed, so no
No, it's
new
closed.
people
No
are
new
coming
people.
into it. So as people retire,
The contribution
the
goes
member
down.
contributions go down.
Okay,
The city contributions don't necessarily go down, but the member contributions will.
because of the people who are retired that are pulling on it.
Right,
Is that
so the
correct?
city has to still pay
cash
for
flow.
whatever the benefits are that
Okay.
we need to fund. And
Okay.
so their contributions will fluctuate,
But they still went down too?
but they still went down too, and we'll talk about why.
Okay,
But they went down as well. On the right-hand side, we're showing the liability and the funding levels. So the blue bars represent the liability for members who are currently receiving benefits. The gold for those who are no longer working for the city but haven't started receiving benefits, so that's a little tiny sliver. And then the red is for the active members who will be entitled to future benefits. And the light blue, again, is that implicit subsidy, and the green line, or the diamonds, represents the level of assets in the trust. So we're a little over 50% funded on the explicit subsidy only, and about 47% funded if you include the implicit subsidy in that liability. Again, we talk, just a sec, we talk about focusing on the funded level, but I want to also focus you on the dollar amount of the unfunded liability. Because again, this is a much smaller program, so the fact that it's only 50% funded has a lot different impact than the fact that the pension plan's only 50% funded.
Right.
The pension plan being 50% funded is what's driving the stakeholder working group
Yeah.
and all of those issues.
53.
53, right. This plan's funded level, the unfunded portion of this is equivalent to about less than 2 years of contributions to the retirement plan, to the pension plan. So it's a much different issue. It also started at 0% funded not too long ago. And so the city's been building up its funding, and it's one of the better funded retiree medical plans, because most of them have started at zero. Many of them have not even come above zero in their funding. But even the ones that have funded, we're in a reasonably good position compared to others. Oh,
sorry, can you help me understand what the city implicit number is again?
yeah, so we tried to go through this in the assumptions presentation last time. It's always the most confusing part of the retiree medical piece. But healthcare costs generally increase with age. The city's plans charge one premium regardless of whether you're an active employee or a retiree up to Medicare eligibility. So for a 64-year-old, for example, the cost of providing them medical care is much higher than a 40-year-old and much higher than the average for this city. The premium's based essentially on the average. And so the implicit subsidy represents the liability for that difference between
I see.
the cost of older retirees and that
Okay.
average premium.
I got you. Thank you.
Okay, so on the next page, we actually get into some of the numbers, and the top part of the chart actually compares the contribution amounts in a dollar amount for fiscal 2020 and next year for 2021. And as Bill says, basically the member contribution is going down from 9.9 to 9.4, and that's really just, since it is a closed plan, people have retired, they're no longer going to be contributing, and so that number is going to continue to decrease. The city's contribution actually, again, is projected to go down, and we'll see a little bit of the details, and it's really caused by two things. One is because the funding percentage keeps going up, there's less that they have to contribute to actually buy down the unfunded liability. And then we actually had decreases, particularly in the Medicare eligible premiums. So the actual liability came down over what it was expected to. So again, that helps lower the contribution. So that's actually dropping from just shy of 22 million down to 21 million. The other thing that's part of this plan is the city does have a cap, so that if the contribution that this board determines is greater than the cap, the city can actually say, I don't want to contribute more than the cap. But the cap is 14% of payroll. And as you can see, the cap is significantly higher than what the actual determined contribution is, so that the contributions would actually have to get up to $43 million before the city could say, we don't want to contribute anymore.
And with the numbers going down, we shouldn't have that, and as people are getting older, they're going to Medicare, so that lowers the obligation.
Right, so I mean, all else being equal, if all of our assumptions are met,
We shouldn't hit the cap.
the city will probably never hit the cap on this
Okay,
plan.
cool.
And then the last one just shows the implicit subsidy, and that did increase, and that really increased primarily because all of the active premiums went up. So on the active side for the pre-Medicare population, all of those plans actually did increase in costs, so that's really reflected in causing that increase in the implicit subsidy. The bottom chart actually compares.
Sorry to interrupt, was
Sure.
that a greater increase than we had anticipated in prior models?
Yes,
Okay.
yeah, and that will vary. It's because of the nature of the way the calculation is done, which is why you don't fund it, because it just goes to the active premiums. It's also heavily impacted by changes in enrollment between the plans, how the age mix is varying between the plans. There's a lot of moving pieces with it, and that does fluctuate quite a bit from year to year, which is another reason not to pre-fund it, because you have the natural source of funding it, which is every single year through the active premiums. So the bottom shows the actual liabilities compared to the assets, so that, you know, if we kind of focus, we can see that the actual explicit liability actually came down from 564 million to 541 million, while the implicit went up from 86 to 91. Assets actually went up from 277 to 294 million. So you can see that the unfunded liability on the explicit, which is really what we're trying to fund, went from 286 million down to 246. So you basically added over 5% to the funded ratio for this 1 year. Then the next slide actually shows what caused the change in the unfunded liability between the implicit and explicit. And so if we, you know, go through the implicit subsidies, unfunded liability, since it's totally unfunded, went up by 4.5 million. Part of that is the fact that essentially you're not making any contributions to fund this, and so the tread water is, what would you have to contribute to keep your same funded ratio, since this is at 0? Any additional is going to just be there, so that is part of that. Plan experience being higher than expected was a part of it, and then we did actually have a reduction because of some assumption changes related to the trend. Actually went down, so basically that reduced it for what it would have been to get to the 4.3. When we look at the explicit, again, it improved by $40 million, and $8 million of it is because we're in a situation where we're trying to buy down the unfunded, so the contribution is higher than what they would need to be just to keep the unfunded ratio the same. investment experience didn't meet the target for the plan, so therefore there was an investment loss of just under 11 million. But again, the plan experience, which is really driven by the Medicare premiums, actually being flat or in probably for half the plan actually went down because of negotiations that the city made with the carriers that actually provide the coverage. Actually, so the liability goes down because we assumed they were going to go up by 6%. Instead, they actually went down by 5 or 6%. So you get that 12% variation. They went out and they basically changed carriers. So before they were using Blue Shield
I
for that
gotcha.
population,
Versus
now they're
Sutter.
doing Blue Cross.
Yeah,
Right, so,
yeah,
and so
yeah.
basically the premium rates they were able to negotiate were much lower than the older premium
Okay.
rates. So the city basically saved some money. And then the assumption changes, again, primarily trend, made it another $9 million. And then there's a really tiny piece that there's still some money floating around from the Viva transfers because individuals had the opportunity to select to basically opt out of this plan and go into the Viva. And there's still some adjustments that are being made, so there's a $20,000 adjustment for that. And then this next chart really projects that if all of our assumptions are met, in the next 18 years, this plan will actually be fully funded for the explicit subsidy. So that's, you're really on track to have it completely funded in a relatively short period of time. The implicit always remains until everybody is Medicare eligible. So that plan continues to grow a little bit, but again, from the plan's point of view, in 18 years, it'll actually be fully funded.
I have a question, and sorry, I just don't know enough, so apologize. When people become Medicare eligible, the benefit to staying on the city plan is, you're still under the umbrella of whatever you had. So let's say you have Kaiser, The plan doesn't pay for like the supplemental insurance or anything like that?
Well, that's
or-
essentially what the plans are, is they are supplemental to Medicare.
Okay.
So basically, there's 3 options for people. One is the Kaiser plan, which is a Medicare Advantage plan, which
Right.
really, essentially, you're giving up Medicare, and then you're getting all your coverage through Kaiser.
Right.
Or you can take the Anthem Blue Cross HMO. It works just like that same kind of plan, but it's an Anthem plan, so you have access to all of their providers across the country. So an individual could live here part of the year, live in Arizona part of the year, or whatever, and they're kind of covered. And the other one is a PPO, which is one of the reasons it saved money is they switched to what's called, more detail anybody probably cares about, is actually a Medicare PPO. So it works like a Medicare Advantage plan, but like a PPO, so that there's in-network and out-of-network doctors, so that you can kind of have more choice. So basically, it does cover everything, but because Medicare's giving those plans a big hunk of money to do this, the premiums are significantly lower.
Okay.
And
But we
so-
still pay for something.
But you still pay for something. Essentially, what the plan covers is the retired member gets the cost of the lowest cost plan that's offered to active employees,
Right.
which is the Kaiser high deductible plan. And so if you pick a plan if you pick that plan when you're under 65, your coverage is free. You pick any other plan, you pay the difference. That amount doesn't change when you go to Medicare. The Medicare premiums for the Kaiser plan and the Blue Shield HMO are actually lower than that amount. And so basically, anybody that picks one of those 2 plans has free coverage. If you pick the PPO, it is still a little more expensive than that plan, so you do have to pay a little bit extra to have that plan going forward. And then, so basically, on a longer-term basis, because we're doing long-term projections, since they're all using similar trends, you're basically saying anybody that takes one of the 2 HMO plans has free coverage for life once you get Medicare eligibility. And it's covering all of your costs except for the co-pays that you have to pay for services.
And so the plan, we pick up that differential, that if you didn't have this benefit, you would, as an individual who is on Medicare, would be paying themselves. Is that right?
That is correct.
All right, so that's the cost to this.
Right.
Analysis.
Exactly. It's the premium payment that the member's getting paid for
For
actually participating in this
supplemental,
plan for the supplemental insurance, yes.
Okay, all right, I was just, thank you.
And so what this chart then compares is the actual projection of the contributions, and it goes back to what they were starting in 2011 and then going forward. The purple bars at the bottom are what the employees are going to contribute, and as you can see, that's at around 9 million for 2021 and continues to decrease until the last member actually retires. The yellow bar in the middle is what the city's contribution is. And again, the city's contribution for the explicit still stays around that $20 million to $22 million level. And then once the plan is fully funded, it goes away, because at that point, the plan actually has enough assets to pay all the benefits. You can see the explicit is still there and will always be there until everybody is Medicare eligible. And so what this really shows is that the red line at the top is what came out of the evaluation we did last year. And so you can see the actuals are below that line, so it's showing that actually it shows the impact of that improvement, so that contributions are a little bit lower than what they were based on our last projection, but they're pretty close. So they're in the $20 to $22 million range for the city for the next 18 years, and then the plan's fully funded and they go to zero.
So we do have an interactive model if there are any questions, but I think essentially that sums up our evaluation for the OPEB plan.
Okay. Questions, comments? For this one, we need a motion and a second to accept the OPEB valuation results. And this, as we did with the pension results, will go back to the city for incorporation, the rates and the funding in the budget process. A motion second?
Motion to accept it.
Motion from trustee Jennings, thank you.
Yes, second?
Second from vice chair Chandra. Any discussion? All in favor?
Aye.
All opposed? That one carries. Thank you very much. Then we're moving on now to item 5D. And FYI, I'm planning on after 5D and 5E, I'm planning on a 5-minute break.
So this item is our 5-year projections, which are primarily for the city's budgeting purposes. So they've laid out what information they want from the valuations. So it combines both the pension and the OPEB and projects the city's contributions for 5 years. And on the pension side in particular, it breaks out normal costs from the unfunded liability, because the unfunded liability payment is a fixed dollar amount, and the normal cost is a percent of pay. And so the city budget office adjusts the normal costs dollars for their estimate of pay based on budgeted positions, as opposed to our estimate based on the valuation data. So there's nothing new here. This is just a combination of the information we presented back in December on the pension plan and today on the OPEB plan to give the city information it needs for its budgeting process.
Okay. Any discussion? Okay, thank you very much. 5E.
So this next item is talking about assumptions for actuarial equivalents for calendar year 2020. So essentially, the pension plan has to specify the assumptions it uses to convert optional forms of payment. So when someone retires, their benefit is either in the form of a single life annuity if they're not married, or a 50% joint and survivor annuity if they're married. But they have the option to select different forms of payment, primarily to give larger benefits to their beneficiary upon their death. Those options are more expensive, they cost the plan more, and so we do an actuarial equivalence calculation to reduce the benefit amount so that it has approximately the same value today at the time they retire, regardless of which form they take. So, for example, they may have a benefit of $1,000 a month as a single life annuity, but if they elect the joint and survivor form, we might reduce that to something like $900 a month, so that it has the same overall value. The assumptions we use to calculate that are the actuarial equivalence assumptions. For this plan, there are 55 different tables we have to provide to load into the pension administration system so that they can handle all the combinations. The combinations vary depending on whether the retiree is a service retiree or a disability retiree, whether they're married or not married at the time, and what the default form of payment is. And then the big multiplier is the COLA provisions. So Tier 1 has a 3% COLA. Tier 2 has varying COLAs depending on how much service they have. And so when you multiply all those together, plus if someone gets a divorce and splits their benefit, often the benefit is converted from the life, being based on the life of the member to the life of the alternate payee, the spouse. And so that's another conversion we have to perform. So all in all, for this plan, there are 55 different tables that get loaded into the pension administration system to handle this. Prior to Measure F, this plan,
Can I ask a quick question?
yeah,
So the COLA for the Tier 2, when you say depending on service, that's length of service or when you actually joined as a city employee? Did people-
it's length of service at retirement.
Oh, okay, so it is, okay.
Really?
Okay, that's more fair, okay.
Yeah,
I wasn't
and
sure.
so some of these,
Still not as good as Tier 1.
some of, right. But some of the higher COLA amounts won't come into play for a while until we have, until Tier 2 members have a chance to accumulate more service.
Okay.
But they're maintained in the system.
And do you model
anyways.
that based on like average length of tenure in a particular role, or is it more macro than that?
So it's more macro than that for the valuation.
Okay.
For these, we don't have to model the probability of being in it. They know when they retire which category they're in, and then they look up and use the table that applies to that
Okay.
COLA category.
I
Yeah,
thought
Okay, yeah, that makes sense.
Tier 2 was based on COLA, like, or the, not COLA, but, I'm sorry.
The inflation.
Yeah,
I'm sorry.
Thank you.
Yes, there's a distinction here. The Tier 1 is 3%
Well, that I
regardless
know,
of what
but I'm talking
inflation
Tier 2,
is.
yeah.
Tier 2 is inflation up to a maximum of those numbers.
okay.
So
to.
the original Tier 2, it was up to a maximum of 1.5%
Right.
per year.
So this is depending on service. So if they've been here, what, 5 years, it's less, or what? Wasn't
I can't
aware of that.
remember exactly where the service breaks are.
1 to 11 years
Yeah.
is the first band.
So up to 11 years is the 1.25?
I think the point is that depending
Yes.
on the years of service and the CPI at the time
CPI,
of the retirement, that they will get up to the maximum of those numbers, depending on the years of service.
And we assume they get the maximum because our inflation assumption is 2.5%.
Oh,
Yes.
so that just overrides that.
So
That's
that,
right.
Okay. Is Tier 1 capped at 3?
Yeah, the
okay.
Tier 1 is a 3
So-
fix.
Fix,
Maybe
okay,
three.
same thing.
Yeah,
So
it
inflation's 3.5, it's still 3.
Yeah. you
Okay.
just-
if inflation's 1, it's still 3.
It's tough,
Yes.
yeah.
Oh, that too. Okay.
It goes both ways.
Both
It
ways.
goes both ways.
So is there no provision in the contracts then, if we experience a spell of extremely high inflation, that those rates are increased, or?
There
Pensioners
is
just lose
a guaranteed purchasing power provision that kicks in at,
70 or
75%?
75. 75%
So we have
of
a-
purchasing power.
we do, so if your original retirement benefit loses 25% of its purchasing power compared to inflation, that's the floor, and you get a supplemental payment. We have a few people who qualify for it who retired back in the early 80s, I think. So prior to Measure F, the municipal code just referred to this board to decide on the definition of actuarial equivalence. And so our practice had been to update the definition every time we did an experience study. So we just did an experience study. We changed the mortality tables. And we've had some changes in the discount rate in the interim. And so we would have normally just brought this as a once every 4 or 5 year adjustment to these factors. But Measure F changed the code and essentially said that we need to use the assumptions used in the prior valuation. So like for 2020, we need to use the assumptions from the June 30th, 2019 valuation. And so that keeps it always current. But it also said, it pretty much specified the assumptions we have to use. There's one thing that we do have to decide. But it said that it also has to be adopted by resolution of the board. And so that's why we're bringing this forward to you, because even though I'm going to tell you what all the assumptions are, you have to adopt it by resolution of the board. So, and the other piece is we use generational mortality. So the mortality assumption effectively changes every year, and our projection scale changes every year. So these tables will have to be updated every year. There will be minor adjustments every year. Based on the municipal code and what we used in the valuation, we will use 6.75%. The COLAs will be based on the plan provisions. We'll use the mortality tables from the valuation, but for these calculations, federal law requires that we use a unisex mortality. And we can't use separate male and female mortality because that would produce different amounts for males and females. And so that's the one decision the board gets to make, is how we blend that. I noted that the system is about 55% male and 45% female. We could match that. I think we'd recommend what we've done in the past is just assume 50% male and 50% female. That's a very common assumption for a system, a general system like this. The actual data is relatively close to that, and the differences would be very minor. And it keeps it simple, so then effectively we have the same mortality table for members and for beneficiaries. So I guess I understand we don't have a resolution, is that? So maybe we could make this decision and do a motion to create a resolution, is that the approach?
Mr. Lederman, I'll follow your lead on how
Thank you. Yeah, as you see from the language of the municipal code, it requires actually a board resolution. What we can do today, so we don't have to revisit this at another meeting and have a formal resolution, is a motion could be made to adopt the recommendations of the actuary and to direct staff to prepare a resolution for execution by, I guess, the board secretary. Mr. Peña, don't you sign resolutions?
Yes.
I don't know, I think
I'm
it's,
told by staff, I'm the board secretary, but I wasn't sure if the resolution was signed by the chair
The
or
chair.
by myself,
yeah,
yes.
anyway, the motion would be to direct staff to prepare a resolution to be executed by a duly authorized officer of the board.
Thank you.
Consistent with the recommendations of the actuary, including option 2 as to the blended mortality tables.
That's a motion? I'm sorry, you can make it.
But,
If somebody who can make a motion wants to make that motion.
yeah, I'm happy to make that motion.
Okay, motion is made by Vice Chair Chandra. Second? Second by Trustee Sun. Any discussion, any other discussion? So this accepts that report, and it is option 2, correct? Yeah, to keep it simple. Yes. Okay, all in favor?
Aye.
Any opposed? That one carries. Thank you very much.
All right,
Thank you very much, Bill, Michael. All right. So that takes care of item 4A, 5D, and E. So next would be 4B, but that's time certain at 10:30. So we're going to move forward to new business. Item 5A, oral update from the CEO.
Thank you, Mr. Chair. Just a couple of items. 1099 forms for retirees will be mailed next week. Also, next week, we're going to be sending out the letters for active members, inactive and deferred vested members for the member direct, so they can sign up into the new pension administration system. I also wanted to let you know, we spoke about it briefly in the presentation by Cheiron, which is one of the reasons there was a decrease in cost. The change in open enrollment between the SOTR and the Anthem HMO. And so we have some issues at times with retirees. We have received many calls from retirees. I think once they made the transition to Anthem, for a variety of reasons, but most of them, maybe they didn't read everything in detail. They realized that the doctors they have in SOTR, they didn't have in Anthem, and there are other reasons behind it. So we have received a number of calls at the office to see if they get a chance to remake the decision, and of course they can do that because these are decisions that you actually make only once a year, the open enrollment, unless you have what is known as a qualifying event. So absent those two, they cannot make changes. So I just wanted the board to be aware of that because you may get calls, especially you, Jay, as the retiree representative, because they want to make changes and they're not able to do that.
I have received calls,
You have, see?
which I've given to Barbara and her staff. So,
Okay, so this is
Thank
going
you.
around and that, okay. That concludes my comments, Mr. Chair. I'm happy to answer any questions.
any questions for the CEO? Okay, very good. We'll go on next to item 5B. Unfortunately, council liaison could not be with us today. So next we'll, so we have a 10:30 time certain. Would anyone have a preference for a break now or before 5C or after 5C?
Are we done with 5 if we do 5C?
And we also have 5F, the fiduciary training.
And we'll have to do that after the time certain, probably?
Possibly.
Yeah, possibly. It depends on how long that goes.
I say we do C and then take a break.
Okay. All right, 5C, discussion action on committee assignments. So there's an item in the packet. Let me, I'll kick that off because I put this one together. And I'll kind of talk you through the logic of this, and then I will also provide an opportunity for Vice Chair Chandra to address this investment committee specifically, and then we'll open it up for questions, discussions, and/or motion. So in the document that you see there in front of you, for me, it started with a question of math. Thank goodness we are now fully staffed on the board. Thank you, Trustee Jennings, for joining us and making that happen. And then with the committee assignments, there are 12 slots, and that means for the 7 board members, everyone serves 2, except for a couple people serve 1. So that's the way it laid out. So I started off with the JPC down at the bottom, the Joint Personnel Committee, because that one does have, per charter, a requirement that the chair and the chair of the IC, the chair of the board and the chair of the IC are part of the JPC. So that would be myself and Vice Chair Chandra. You see Trustee Orr is there. You may recall that back in the December meeting, we observed that Trustee Orr was on the board and all 4 committees. And we just appointed her to the JPC in December, so I thought I would just keep that there and not displace the most recent decision that we made.
Can I
That
ask what that committee is?
Joint Personnel Committee, you can probably do this as well.
Yes, so the Joint Personnel Committee is really the only committee of the boards that is joint. We have some committees that meet from each board, they meet jointly, but this is actually a joint personnel committee, which means that there have to be a quorum of, the committee is comprised of 6 members, and there have to be 2 from each board to have a quorum for the committee. And the goal of the committee is really to do a couple of things. First, and they're working on that right now, is to establish the policy for the performance evaluation of the CIO and the CEO. So they're still working through that process. And they also are now working on developing the performance metrics they're going to use for that performance evaluation process. And once that's all completed, then they're going to be a committee that they're going to be making sure that the performance evaluation policy is followed every year. So they're going to be the committee that is going to take the lead on the annual evaluations for the CIO and the CEO.
I see, thank you.
And just as a sidebar, Trustee Jennings, the charter for all the committees, it's on, if you go to the Federated website, there's a tab on the upper right-hand side.
Yeah.
It talks about governance, I think it is. and
Standard operating procedures?
Standard operating procedures, yeah, and then the charter for all the
Explain
committees
it.
will be.
Yeah, we had a meeting yesterday, but as you know, I was out sick, and I was going to go over
Oh.
with all the charters, but we
Oh,
will
okay.
certainly go
We'll do
over
that.
that when
Okay,
we
gotcha.
meet, yes.
Yeah.
Sounds good.
Great, thank you. So, again, I start with the JPC because it has some seat-specific requirements. And then when I went back up to the investment committee with Vice Chair Chandra there, and so we have, we're quite fortunate in that we do have, of the 7 members, I'm probably the one who does not have investment knowledge and experience. So we have 7 very qualified board members that are potentials for the investment committee. My understanding, and Vice Chair Chandra can speak to it in more detail after I go through this, but we've got some things coming up in 2020. And we're very fortunate. We have a couple of people who have a very specific skill set relevant to the work plan for 2020 on the investments committee. So we have a couple assignments there. I do also want to point out that because we do have so many people who are qualified, who have a good skill set for this area, We did, for the first time, create an alternate seat on the IC, and in this one, I am, so we have Vice Chair Chandra as chair, and then trustees Orr and Kelleher, and then the new one, the new alternate seat, I'm proposing that trustee Sun serve on as the alternate. And council can speak to this a little bit more on how the alternate seat might differ from the regular committee member seat, what they can and can't do. And then the governance committee, if I can go to that one next, it made sense, I believe, for the chair to serve on the governance committee, so I slotted myself in there on that one, and there's my two. Then trustee Sun, I'm proposing her to be chair, primarily because we went through fiduciary training together through the CalPERS, CalPERA. So I feel like I know a little bit what she got from that forum. And then trustee Horowitz, in a very small snippet of a conversation, we discussed between the governance and audit that governance might be a better fit. So that took care of the third committee, the governance, and then still following through on math here, trustee Jennings, I put you on the audit committee because you had not yet been assigned one. Trustee Sun is on the audit committee. I know I have you as an alternate and a chair, and I hope you're willing to accept the audit committee role too. And I assigned the second seat for trustee Kelleher as chair because trustee Sun, you already have a chair assignment, and trustee Jennings, since this is your first meeting, I thought I would give you a break there. So that's how it played out for me in creating the assignments. And, frankly, to me, playing with the math and just how the assigned seats, it actually worked out quite easy, given what we've got. I mean, it is 12 seats for 14 possibilities if everyone serves 2, so there were some decisions I need to make. And so this was my best shot at it. And then Vice Chair Chandra, if I could ask you to make a couple.
Yeah, on the investment committee, I wish, I had actually talked to Roberto about whether that could be a committee of 4, and unfortunately, that invokes a quorum. We're not as big, so police and fire, we do a lot of our investment committee meetings. The format is we meet separately, just as a federated investment committee, then we meet jointly with JPC because we share one CIO and one staff, and there's a lot of overlap between our plans. The asset allocation varies a little bit, but a lot of the manager selection is the same, and a lot of the issues are the same, and a lot of the great speakers you have come to make us smarter in our roles are shared. So those are done jointly, and then the police and fire meet afterward. Well, they have 4 people on their committee, so I was hoping we could do the same thing, but they're a board of 9, so they don't invoke a quorum by having 4 people present. We do. As I was looking at our work plan, so we've benefited from having a planned member on the committee in the past. I think there's a bunch of reasons why that's a good thing, and trustee Sun is a planned member who also has a keen interest in investments, and of the people on our board seemed like the most obvious choice. We also have Mark Keller, who's new, who has a specific skill set that could be valuable to us right now. We're in the process of working with Cortex on redefining the relationship between the board, the investment committee, and the staff, and we've delegated a lot more authority to the staff and to the CIO's office. And while we have a terrific CIO and an incredible staff, I don't believe they plan on serving lifetime. They're not Supreme Court justices, so we really need to institutionalize something that outlasts them and make sure we're not delegating too much or too little. And the area in which I'm most concerned is around manager selection stuff. And Trustee Kelleher spent his career at Mellon Bank reviewing manager selection for large institutions, going in, evaluating them, firing them, doing all sorts of that kind of gritty work. And so that could be really valuable to us right now. Trustee Orr and I probably have a more overlapping skill set in the asset classes that we've worked in primarily, and Trustee Kelleher is a good complement to that. So for the near term, we had a discussion, Jay and I, and we thought this would be a great way to leverage his skill set as he's coming onto the board brand new as well. I think he's only been here for 2 meetings. So that's why we wanted to kind of fudge it and add another body, create a little more horsepower in the investment committee. And I think, Council Liederman, you're okay with that? You're supposed to say yes.
Yeah, yes. No, just to explain to those who haven't been through this, the open meeting laws, the Brown Act, that govern how we meet as a board, require that standing committees of the board be less than a majority of the board. Otherwise, it becomes a board meeting. And so we have to be careful that since our board is 7, our committees can't have more than 3. We can name alternates. However, the role of the alternate obviously is if one of the members can't make a meeting, that person can take the place, fill the vacancy for that meeting. During the committee meetings, the alternate cannot vote, cannot act as a member of the committee, but can certainly contribute comments and participate in the discussion just as any member of the public can. These are public meetings. It's a standing committee of the board. And so they're Brown Act, they must be agendized and published and noticed, and they're open to the public. And so an alternate in that situation, if the other 3 members are present, the alternate may participate in the conversation just as any member of the public may, but simply cannot vote if the other 3 committee members are present.
And can vote if someone is
And can
absent.
vote and participate. Now, we can't have tag team substitutions during the course of the meeting. If one of the members goes out,
sure.
you know, to take a phone call, the alternate can't sit in for a few minutes, and, you know, so you set your quorum and you're voting at the beginning of the meeting, but that way the alternate can be fully educated, get the materials, they're all public materials, and can participate and be up to speed if called upon later in the year to actually sit in and substitute for, as a designated hitter for a standing committee member. So that's, I'm perfectly comfortable with that.
Can I make a comment? I'm very disappointed with the committee assignment. If you know, I'm assigned as alternative committee. That means I'm in 3 committees, and I have to prepare for all committee meetings. That's a very heavy workload. Just to remind you, I have a heavy workload on my desk anyway. I manage a $2 billion portfolio for the city, and have a 17 work group under my management. That's very heavy workload. Serving 3 committees is almost too heavy. It's almost impossible for me. And I talked with Trustee Chandra a couple of weeks ago, and then I think it's not a secret that I've been voicing my interest in the investment committee since day when I was here. I talked when Matt was the chair, and I asked him what's the process of being selected for the investment committee. And he said he will consider me when there was a vacancy. So when the vacancy occurred, when Bill left, and then he put Trustee Orr onto the committee, and his reasoning for me is that he thinks she thought there should be a balanced view on any issue between the external member and the internal member being members and the retirees. And since he was still on the committee, he said that I would not be picked. I said, okay, I agree, that's a point. we don't want to have an imbalanced view. So now when current is a vacancy became available, now I'm became an alternate. So that means I cannot cast my vote, but I have to prepare for everything. And you have all know, I worked very hard on this board, and I read every single thing, and that's too heavy for me. And then my point is, to be serving on the investment committee is to get an insight of the decision-making on the investment decision, which is one of the most important things we do here. I think as a plan member, beneficiaries, we should know, we should understand how decisions are making. Yeah, I do agree there might be some plan target for the investment committee on the investment manager selection. I want to make the board aware that I'm not totally a greenhorn on the manager selection. I worked on investment committees before. I have worked on investment manager selection before. I have evaluated a lot of investment managers. Yeah, maybe I'm not an in the industry insider, managing a fixed income portfolio, albeit this is big size, $2 billion. I'm still looked down upon as like a second-hand, like a bastard child, or whatever you call it. It's not as sexy as a private equity investment, but I do present a different view, to bring a different view to the committee, I think. I understand the city finance pretty well. I think any decision you make, I probably will bring in more inside view to see how that's going to be impact to the city, government, and then to the plan members. It is our money. We depend on that, a lot of us. For most of the, for most of the retirees or the employee of the city, probably that's all they rely on for their retirement. It's very critical to us, for us to understand how the decision to make. So I really hope the other board member will consider putting me as a regular member on the investment committee instead as an alternate. If you insist on putting me as an alternate, I have to decline that role. Sorry, I can't function. I cannot serve 3 committees. That's just too heavy workload for me.
Maybe before we go on to another topic about the same agenda item, Trustee Sun, so there's a couple things. One is you want to be a regular member of the investment committee, and 2, the other issue is being on 3 committees. So on the latter, it would be, I think I could do a couple of juggling things here to reduce your load. I'm not sure if I can get you down to 1. Well, any other comments, and I'm going to play with the list a little bit. Trustee Horowitz.
Yes, and expanding on Trustee Sun's comments, 2 thoughts come to mind. As she mentioned, the investment committee now consists of all voting members who are industry insiders. So I think the IC would benefit from a diversity of views and experiences. And to that end, I'm wondering if we can have some type of systematic protocol by which trustees are rotated through the various committees so that we can achieve this diversity of thought and opinion on the various committees, particularly for the IC, which seems to be the one that everybody wants to be on, and we don't have enough seats for. So,
Yeah,
if you
on
have
that
any
last,
comments on that.
on that last point, we do the committee assignments every year. That's my understanding. So I think it might be too disruptive to do it more than once a year, but we do this every year. So this isn't a one-time thing that might stay in place for 2-3 years. I mean, we will look at it every year, and especially with regard to the investment committee, my understanding is we're focusing specific skill sets on that committee for the 2020 work plan. So there are, in that sense, that need is short-term. But yes, we will be looking at this on a regular basis. And we're totally open to that. I'm just trying to meet a business need for 2020 on that particular committee.
Well,
I guess-
Go ahead.
I would also support having trustee Sun be on the investment committee, given that her background is, $2 billion, that's significant. And also, she is a city employee, so she does have that perspective, which I think is beneficial. And if we do have the opening, I think makes sense. And maybe, I totally, with the responsibility she has, she should, only be on 2 at the most, if she's willing to do that. So I support that.
Thank you.
Just one comment, in terms of insiders, I think I'm the only industry insider. Mark's retired, and you're not with a fund currently, right?
I'm more of a working sabbatical. I like to understand what an
So-
industry insider is, because it denotes something
Yeah,
not
exactly.
so
No,
nice.
it's like,
It's like
It's like-
watching an insider.
yeah, exactly. I don't, it's usually a pejorative term, so I just want to make sure it only applied to one person. So far on the committee.
I didn't mean to use it in a pejorative sense. I think
it was.
I was speaking more experientially,
Yeah.
not in terms of what your current roles are.
Yeah,
Um,
so,
And I appreciate that we have a work plan for the next year, but there'll be a work plan for the year beyond that.
That's right.
And if we're going to incorporate the diversity of views and talents that are on the board, I appreciate the openness to reviewing this annually, but I'm just wondering if we shouldn't have a more formal process by which people are rotated through. It sounds like trustee Sun has been seeking this position for perhaps a number of years, and various reasons were put forward for delays in that. And I think we would all benefit if there was a more formal protocol by which people are rotated through, so that we can understand and maybe dissipate some of contentions on this issue.
Interestingly, I say this half jokingly, half serious, that point about committee composition, it actually would come through the governance committee and the chair to work through what might make sense and then have it come back to the board for voting.
One of the reasons I sought that committee assignment.
Okay, good.
So I have a couple more thoughts. The first thought is, let's see, let me organize my thoughts because I've got 2 or 3. So the first thought is, I think the committee benefits from having a plan member. So don't think that wasn't, heavily weighted in the overall composition of this, which we're discussing and is obviously can be changed. And I think trustee Sun is not, did you say bastard child? I think she's eminently qualified to be on there. I guess this is an open forum, so I'll be open about it. The whole Cortex project and the delegation has, I've agreed to a lot of the things in our committee, which has come back to the board, so the board has fully supported it. But I think the board typically looks heavily to the guidance of the committee, right? And Prabhu knows that some of this transition was uneasy for me, and it's nothing personal to him or the staff. I think we have one of the best staffs in the state, but we're setting certain precedents here. And the best thing about being an industry insider is I know how to call BS on people in my asset class, because I know when I've gone out and raised money, I know where all the skeletons are buried, and I know where people hide things or package things and promote in market. And you get that from pattern matching. So trustee Kelleher has that in spades in a way that is very relevant to a work plan. And where I do disagree with you is work plans aren't used as an excuse to create committee compositions. I wouldn't have thought of this last year or the year before. This is a unique moment in time. We are literally changing the way we operate vis-a-vis the CIO's office. So I just want that understood, the depth of thinking that went behind trying to match a skill set here. Having said that, I'm completely open. I mean, if we want to try, and I see trustee Kelleher is not here, and I haven't had a chance to speak with him, if he might be interested in the alternate role, My questions there are, how much can he participate and contribute in his assessments of things? He may not have a formal vote, but I would, his commentary would be incredibly valuable. So we're trying to solve for a specific thing. I think that's being lost in this discussion right now. It doesn't mean that it has to be the driving thing. I want to come back to that. I think both in Trustee Keller and Trustee Sun, we'd have an excellent third voting member. So at some level, I'm ambivalent to it. I'm definitely ambivalent to it. I think they'd be both great to serve with. But I want people to understand what the specific concern is as we move manager selection into the CIO's office. And we happen to have a CIO who probably knows more about investments across all the asset classes than all the people on the committee combined. But I don't think that's going to be the case necessarily with the next CIO.
So let me ask, Vice Chair Chandra, and Trustee Orr, would it be amenable if Trustee Orr bowed out of the investment committee and then served as chair of the governance committee?
I would prefer to stay on the existing committee standings as laid out.
Okay.
Primarily, I'm thinking about the fact that the investment committee probably isn't titled correctly. It sounds like it's going to be change management, some innovation, a lot of dynamic elements that is not specific to asset class. That's one aspect. Second aspect is around sort of, I don't want to debate here per se as we think through the process for governance as to what credentials might be, because if we're talking about, I just want to speak to the fact that certainly from a fiduciary standard, I think all of the board members would hold to serving the plan members. That's always a priority and a given, and if we have to repeat it over and over, we will and we shall. With respect to sort of asset level experiences, they're not comparable, right? 2 billion here versus $1 trillion there. It's not the dollars, it's sort of the type of project and product experience that matters. So those are sort of my initial reactions and findings. So my choice would be to stay on the committees as laid out.
Okay. Counsel?
Yeah, I just want to offer one observation that might influence one way or the other. I'm not sure where it would cut, but the only concern that we would have with the participation of the alternate during the regular IC meetings were if the committee is talking about a specific manager, that is, which would take place in closed session, the alternate could not attend that closed session discussion. Just want to make that clear. So, because we have a Brown Act provision that says if you're talking about engaging or disengaging from a particular investment, that is a discussion that you may hold in closed session, and this board and this investment committee has held closed sessions for those kind of discussions, and I would encourage you to continue that. In those closed sessions, the alternate could not participate.
Could not attend or could not?
Could not attend and participate in the closed session discussion. So however that cuts in the conversation, I just want to make sure that you go in with your eyes open. If that is a key aspect of the work plan for this committee for the next year, holding those confidential discussions about specific managers, that is not something the alternate could participate in.
Thank you, Counsel.
Might I suggest a possible change that might satisfy to some degree, and that is that Trustee Kelleher be made the alternate and Trustee Sun be made a permanent member. Therefore, you can still rely upon his attendance and insight and commentary, but that the voting position be assigned to Trustee Sun.
Yeah, I think they'd be both great to serve in that official voting capacity in the third seat. So I'm perfectly fine with that.
Okay, so
Do
we'll
you
make,
have, but I think you might have to jigger some other
yes, I think
committees as a result of that, though.
that's
I
correct.
think there's
It's an n-dimensional problem.
yeah.
So that would take care of, yeah, that would take care of the IC. Trustee Sun, if you're on the investment committee,
Well, you still have the three committee maybe you have to take her off one.
well, yeah, that's, if you're on the IC, Trustee Sun, can you accommodate one more or zero?
I can stay on governance committee. Can I be relieved from audit committee?
Um,
We have to find a place for Kelleher,
Yeah.
and he's already on audit.
Yeah, that's right. So my first crack was going to be, Trustee Sun, if you were to stay on the audit committee, which frankly is a lighter workload.
Okay.
And then I
And then
could
move
put,
Mark to governance.
yes, I can move,
But don't have,
Trustee-
it. But you can't have n-dimensionally, then you're making him chair of two, and that's a little bit of extra work. Would Spencer or
yeah,
you,
then
Spencer, would you be
Trustee
comfortable
Horowitz
being
would be
chair?
chair of governance.
It's a committee you sought out.
It's true, but with respect to my inexperience on the committee, I wonder if being chair might be above my pay grade, but in order to solve this n-dimensional problem, I guess I would agree to do so.
Okay.
You wouldn't be the first inexperienced chair, so.
I'm sure not.
Yeah, I can speak for.
I just hope I'm not the last.
Okay, so the change I'm making on this list is that Trustee Sun becomes the regular voting member on the IC.
Mark Kelleher's alternate subject to his agreement, he's not here.
Yes, yes. So Trustee Keller, so that I would switch those two. And then on the governance committee, chair would be Trustee Horowitz, and then other members would be Trustee Kelleher and myself.
And the audit committee is?
Audit committee remains intact,
And JPC remains
and
intact.
JPC remains intact.
Yes. Just a note that you may have to revisit this depending on what trustee Kelleher says, because it's gonna be in 3 committees.
Well, not necessarily.
if-
No, I mean, if he
Right.
agrees to be the alternate, he may choose not to be in one of the other 2. I'm
It's
just,
the same issue as.
Yes.
yeah,
trustees.
I mean, I'm just saying, he
Yeah.
may not say anything, but he may, so I just want you to be mindful of that.
Yes, well, in that case, we do have, hopefully, we have some flexibility that Trustee Jennings
Yes.
could help out on governance if needed.
Okay, all right.
Yeah, I'd prefer governance. The other one,
Don't worry about it,
Yeah.
we'll be
We'll be
helpful
able-
in other
yeah.
communities, that will be very helpful.
Again, we'll look at this
Yeah.
every year, and I think I've only been on for 18 months, and this is probably the 3rd time we've looked at it, so
Yeah.
it's
that would
not
be fine.
ideal.
The governance would be, the joint personal one just
Yeah.
doesn't sound like.
Everyone
Okay.
should try
Something I'd
serving
be
on 4
interested in.
committees at the same time, and the working group, because it's really fun.
Yeah, right.
Yeah.
Okay, so this one requires a motion and I'm sorry.
Well, yeah, I can make a motion, but do we need to restate the changes that were made? So, or you just did?
Just to make sure
Okay.
that staff has it, yes.
Okay, so
One last clarification.
I'll just go right down from
Yeah.
top to bottom. On the investment committee, I have Chair, Vice Chair Chandra, and Trustee Orr, and Trustee Sun. Trustee Kelleher would be the alternate. On the audit committee, the chair of the committee would be Trustee Kelleher. Other members would be Trustee Sun and Trustee Jennings. Governance committee, the chair would be Trustee Horowitz. Other members would be Trustee Kelleher and me. And then on the JPC, the 3 members would be me and Vice Chair Chandra and Trustee Orr.
Yes.
And if there's no other discussion, I'll make a motion to approve that.
Okay, for the motion from Vice Chair Chandra.
2020 committee assignments.
Thank you very much. A second from Trustee Horowitz. Any other discussion? Okay, can I have a, all in favor?
Aye.
Aye.
Any opposed? Great. Thank you very much, everyone, for that discussion.
Still take a break or?
No, we have to go to the earning.
Okay.
Because it's 10:33 already.
Yes.
Okay.
Okay. So we will,
Go straight to- Okay.
at this point, let's go back to item 4B, discussion and action regarding the repayment of the workers' compensation offset for Danny Horning. Mr. Horning, are you comfortable if we were to take a 5-minute break, no more than 5-minute break? Certainly. Okay, thank you very much. Convene. Again, we're on now item 4B, discussion and action regarding the repayment of the workers' compensation offset for Danny Horning.
Good morning. I'm Catherine Schaefer. I'm the Benefits Division Manager for the Office of Retirement Services, and I'll give you a brief introduction as to the case. Mr. Horning was working for the City of San Jose and was on workers' comp for 2 different injuries, one in 2011 and one in 2014. He was paid in full by a workers' comp settlement on March 1st of 2017, and it carried payments through April of 2020. Danny received a service-connected disability in January of 2017 that was retroed back to July 10th of 2014. What this means is that Mr. Horning was receiving workers' compensation payments and service-connected disability retirements at the same time. Muni Code 328-1040 says that if a member is retired for a service-connected disability and receives both the service-connected disability retirement allowance and workers' compensation payments, then the service-connected disability retirement allowance is offset. Mr. Horning received $103,667.70 in workers' comp payments after his retirement date of July 10th, 2014. He received other payments prior, but prior to his retirement, we do not deal with those. So after the limitations of the offset, which is the total contributions EE and ER divided by ER contributions, he still owes $76,423.84 in principal, and there is accrued interest on top of that. Staff is requesting that repayment of principal and interest begin February 1st of 2020. First, with the offsets that are not past due, which is February through April, and then starting May 1st of 2020 with regular monthly payments of the past due amount plus interest, and those are the same amount each month, $1,225.46, and they run through February 1st of 2026.
Counsel?
Thank you, Harvey Lederman, Fiduciary Counsel. Just one comment about this. This took a great deal of time since these payments were made to get the information and to calculate this. So there has been a passage of time that we neither have to attribute to the member or to staff. But I want to just point out the code section in this situation is mandatory. We don't have a discretion to do the offset or not do the offset. In this situation, the code specifically says that if the disabilities, the workers' comp payments were made for the same disability as the disability retirement, that the amount shall mandatory be offset against the retirement benefit. So there's not a double payment for the same injury. There's no dispute here from the facts that the workers' comp settlement was paid for the same injury that occurred in 2011 that led to this board's granting of the disability benefit. So the only issue is whether or not the board wants to deviate from its policy of collecting 3% interest compounded on the amounts past due. And that is something that would be within your discretion, although, as my colleague, Ms. Krengle, would tell you, the Internal Revenue Service requires plans to recover appropriate interest in these situations, but you have some discretion to decide whether and how much and over what period of time the interest should be collected. Staff has made a recommendation. I think it's fair and reasonable. So those are the parameters just from a legal standpoint. The offset is mandatory. The facts demonstrate that the workers' comp payments were for the same disability that led to his disability retirement. and the amounts are as shown in the staff's report. Happy to respond to any questions that the board may have.
Thank you. Questions, comments from board members? Trustee Horowitz.
The 3%, how is that determined? Is that a statutory number? Or by what means do we come to 3%?
3% is the amount that's stated in this board's policy. I'll have to find out what page that is in your material. I think it's in the material.
It's attachment 4, I believe,
Attachment 4,
is the overpayment, underpayment policy.
it starts on, there it is. Well, I don't have a PDF number page on it.
It says attachment 4, page 1 of 5.
Yeah, that's right, attachment 4.
That works.
Yeah, it's the 10th slide.
Number 1. Yeah, it's on, it's in, after the first page at the bottom, overpayments to members, paragraph 1 refers to
What number?
page 2 of 5.
2 of 5. Okay.
In the top paragraph, about 2/3 of the way down, if the overpayment was a result, et cetera, appropriate interest shall be 3% per annum.
And then, Mr. Ludeman, if I could impose on you, just because we've already used a couple times the nomenclature overpayment, underpayment. For those of us and the audience that may be listening and familiar with the overpayment, underpayment issue we dealt with, was it just last year or was it year before? Could you distinguish how this situation, this case is different from what we did on the other overpayment, underpayment issue? I.e., that one, to the extent there was overpayment, I believe we just shifted that to the unfunded liability.
No, well, okay, for the information of the board, both this board and the Police and Fire Board had, over the last couple of years, situations where there were systemic errors in reporting compensation in various categories for city employees, that the city's reporting was not accurate, and therefore we overpaid benefits to certain members.
And
that
underpaid to
took
others.
considerable time to discover. Those were items that were entirely due to issues in reporting errors on a systemic basis across the board, not for an individual member of the system. In that situation, the regulation, the Internal Revenue regulations talk about that is the obligation of the board as trustees of the trust fund to recoup back to the trust fund the amounts that were wrongfully paid out or overpaid in these instances, even though it was no fault of the member. The Internal Revenue Code regulations on this are agnostic as to from whom you can collect that money. In most instances, it's offsetting the pension benefit being paid to the member. However, it can also be recouped from the plan sponsor by the board, or if you had insurance, for example, on it, if you had third-party insurance, you could recover from third-party insurance for errors and omissions or something like that. In that instance, because the error was attributable to reporting errors by the city to the Department of Retirement Services, a decision was made to recover in part from members who had been affected by it, and in part from the city itself. And ultimately, the part that was going to be contributed by the city was decided to allow the city to do that over the period of amortizing the unfunded liability, because that became an element of the unfunded liability. And an opinion of, the city has received an opinion of tax counsel that that was permissible under those circumstances. That's a long way of saying, in that situation where there was a systemic error that affected many members through no fault of their own, that their board had some discretion as to how to fashion the remedy of recovering the money back into the system. In this situation, the applicable law of the city's municipal code gives us no latitude on that. It says it shall be recovered by an offset to the member's pension benefit. The workers' comp benefits that were paid shall be offset against the member's benefit. So to that extent, our hands are tied by the law. There is an issue, of course, as to whether and how much interest you wish to collect, and whether you want to go by the policy that the board adopted 2 years ago, as you see here, or to fashion something else. But that's relative to the previous correction of errors that we had in the last couple of years. That's where this is slightly different.
Thank you for explaining that. So the principle is, that seems to be cut and dry. So the 3%, it's embedded in policy, and does that run, I'm just asking for myself here, but does that, if we were to do something different from the policy, that of course goes away from policy, and does also venture into not meeting our fiduciary responsibility by not collecting that amount that otherwise might be plan assets?
I would never advise you to violate your fiduciary responsibilities.
Yes, no,
If I were not comfortable that you had some leeway to fashion that remedy or with the interest itself, I wouldn't make that suggestion to you. I think you can. I think the full amount could justifiably be recovered. I also believe that you could decide. You've already, but just through the passage of time, have already pushed this off substantially, and to a great extent, that was at the request of the member.
Yes.
And the member's counsel, who asked for more time, and this was before the board about, I'm thinking August last year,
August
and we
10th,
could have
correct.
made a decision in August on this and started the interest clock running there. So you've already, granted some disposition of at least 6 months. Now, we've taken advantage of that period of time to refine and get better information on the numbers, and the numbers have changed. I will say that, in fairness. The numbers have changed because we've just sharpened the pencil of trying to really focus on which payments for workers' comp were attributable for which period of time that overlapped with the retirement benefit. So we wanted to make sure we had that locked down. I'm comfortable, I think staff is comfortable that we now have that locked down, as a matter of fact. So, but I would be comfortable from a fiduciary standpoint if you exercise some leeway of discretion relating to the collection of interest. One method that we've used in another system that another board had adopted in a similar situation was to have a forgiveness of interest if the offsets were successful through the next couple of years, through the first part of the program. There might be a forgiveness of accrued interest at that point and beyond. So there is some leeway here. But the important thing is to get this started in collection now, because we're under a mandatory obligation under the code.
Thank you again for that explanation. Okay, any other questions, comments, or is there a motion?
Can I say
Oh,
something?
I'm sorry. I'm sorry, Mr. Horning, please.
He's not an alternate.
Yes. Yeah.
So I've only had an attorney for the last 4 months. He came last time for the first time, and that's when you guys decided to extend it. Before, it was not really me, it was just, they didn't have the numbers right. We were disagreeing, but I never asked for a postponement. I think the interest is wrong to charge me for a mistake I didn't do, and if I was overpaid, I want to pay it back, but I don't think I can do that $1,000, $1,200 a month. It would just kill me. I'd be homeless. So if I can extend the payment. And then one more thing is, my lawyer says that if you went with the Dr. Dickman's report, you wouldn't have as much to collect because he said something different than the other doctor. So by you guys choosing which doctor to take the report from is a big difference in money. He couldn't be here today. He would have been, but he's out of the state in a lawyer conference. I wish I had a representation guy, but I won't be able to pay no $1,200 or $1,000 something a month. I'll be homeless. But I will pay, I can pay like $500 a month till it's paid off, but that's it.
And I'm, whether it's counsel or Ms. Schaefer, could you clarify regarding the length of the payments, the term?
The
Where-
payments
where-
are spread over, according to the policy, you spread the payments over the same length of time that the payments were made. The payments were made for a period of 70 months, so we spread the repayment over 70 months based on that.
Okay.
Roughly 60%. 6-year payback period.
Yeah.
And so what's the monthly payment again? Can you just,
Well, there's several, because there's 3 payments that aren't past due. The first one's $885.69. The second one's $946.78. That's February and March. April is $711.22. Then it rolls into the repayment of the past due, which is $1225. Let me find, so I can give you the pennies.
46.
Yep.
Yeah. So it's basically, yeah. And that would run until February 1st of 2026, if this repayment plan is agreed to.
Okay, I'm gonna just be a little silly here, but I'm a little confused by this. Are these individual amounts, or help me understand what I'm seeing
The
here?
February, March, and April is based on the payments he received for those months and what the offset would be that he had to pay back. That's why they fluctuate. Then, when we roll to the past due amount, we follow the payment policy, and we set it for the same amount every month, which it states in there I'm supposed to do, over the period of time for which he received the payments.
Okay, so the total monthly amount is $1,225.46
That he would be paying.
that he would be paying.
And that's
And
with interest or?
that includes the
That
3%?
includes interest.
So I'm just curious, do you have what that number would be, you know, let's just say at 0 interest, at 1%, at 2%?
I do not.
Do you have an idea what it might change?
Well, we have a number for the principal alone, so at
Do
0%
we?
interest
Yeah.
would be closer to, I
Yeah.
don't know which
Yeah,
page this
you
is
do.
on, but it's
It's too
about,
tiny.
So
it's a 1,000.
it's the difference between 76 is the principal alone and 85, so it's about $9,000 worth of interest.
Over
Spread
six,
Over 70 months.
So it's not going to make that much.
it's not,
Yeah.
it's gonna maybe a couple hundred.
Take it down to about 1,060 or.
So we're being held to this 70 months, right, legally?
Correct.
We need to do that.
Right.
We don't have a choice.
Well,
that
let me
right?
ask, is that,
So you can see the
That's
principal
policy.
payment, they
yeah,
vary.
policy, so just like, if I can follow up, I'm trying to explore the range of possibilities for the board.
Yeah.
So we have the 3% in policy, but there is some flexibility in it without breaching our fiduciary duty. On the policy about the 70 months, i.e., paying back over the same period over which the payments occurred, how much flexibility do we have there?
Can we change payment?
You could,
maturity?
you certainly, the board could decide to depart from its standard, policy. We state in the policy that exigent circumstances may require the board to depart from the policy. The policy really is designed for more systemic errors. And so there is some leeway in the policy to extend the period of time or shorten the period of time, depending on the circumstances.
Just to clarify, make sure I understand, the policy was established April 2015 by the board members at that
Correct.
time?
Yes.
And it's to be reviewed every 3 years or some time frame. I think it says at the very end.
Well,
So my question is, have we reviewed this since 2015?
2015.
At some point, whether by a prior board, or is it on our docket to
I
review?
don't remember
Maybe
if
we're
we made
reviewing it now?
amendments to this. I actually don't remember if
Okay.
we made amendments to this in the
Yeah.
last couple of years.
So we do have the authority or bandwidth to modify at some
Absolutely.
stage, okay?
Absolutely.
So the number that we're really held to is the 76.
Yeah. it's the
That's
amount.
the amount, period, okay.
All right, so I don't think we want to put this gentleman on the street, assuming that what we're being told is accurate. That just wouldn't make, I don't think we're doing the right thing for the person and overall. I think we have to follow what we're being obligated to do, and he does need to repay. There probably should be some interest. I don't know if 3% is, would he even be getting 3% if he had invested it? Probably not. Extending it beyond the 70 months seems reasonable to me, but getting it to a payment that he can actually live with.
Right.
I
Something
would
that's
recommend
realistic,
that.
yeah.
Okay.
And I'd be comfortable with a longer time period.
Yes.
And I'm not even wild about the interest, since it was not the responsibility on his, he had
Right.
no control or interest or way to, create this resulting
Right.
situation. So the error or systemic error or obligation is borne by another party.
Yeah.
Just to put something on the table, I would propose doubling the maturity date to 140 months. That pretty much gives him, makes it around 500 for you, sir. And then I'm in agreement on interest, that, while I think the members have a responsibility to understand what they're receiving, some of these calculations are complex. Sometimes it's obvious, hey, I'm getting double paid, sometime, or more than I should, but it's not always. And I don't think we have time to go back and audit it to that degree, but I take the gentleman at good faith. And I would, and by the way, whether we waive the interest at all, not at all, or somewhere in between, it's not going to affect that. I think the moving from 70 months to 140 months is far more important. You're talking like $30, $40 a month on the interest, but I'm with you in principle. In principle, I don't agree with it. And this,
It's like an extra slap.
yeah, for something he didn't really have.
May I read something off his application that he signed?
Mhm.
This was back July of 2014. Federated retirees, I understand that if I receive a workers' compensation payment due to a service-connected disability, the retirement office will offset the retirement check. This is something that he initialed.
So, Vice Chair Chandra, was that a motion that you put forward that is?
Well, I want there to be discussion. I guess there's discussion after a motion
Yes.
too, but
Yeah.
just to get something out there.
Yes.
So
So
we
that
can
would
start
be-
talking more concretely about a solution.
And that would be at 0% and 140 months?
That's what I was saying, yeah.
Oh, okay, I just wanted to understand, that's what I understand.
Before you, can I ask a question to Mr. Horning? Mr. Horning, do you mind I ask you, how old are you? What's your birthday?
58.
Okay.
Is there a second on that motion?
I second.
Okay, second by Trustee Jennings. Other questions, other discussion?
Can I share one comment that might be helpful to you?
Yes, thank you.
On the interest concept. So from, a tax and fiduciary standpoint, you do need to restore the plan to the position it would have been in had you not made the overpayment. So it's not so much what the member
Would
would
have made.
have earned, but what the plan would have. So I would think of it not so much in terms of waiving interest, but in terms of where the interest goes. So if the interest is not collected from the member, then it becomes part of the unfunded liability and indirectly is collected from the employer. And so it, may be semantics, but important to be reflected in the decision that ultimately the fund recoups the interest. It's
Very,
just in terms of
very
how
good
you-
point. You're absolutely right. And I'm fairly sure that over the last 7 years, collectively, we have made more than 3%. So, I mean, the plan. So asking for the 3% will be more than reasonable at this time. Just to put the plan back where it would have been, or otherwise, you are correct. The employer is stuck with that part of the unfunded liability because, in essence, the plan was made whole.
Or the plan becomes whole when it eventually recoups it from the employer. So even if you
Yeah.
were to go to zero in
Yes.
terms of what you seek from the member, you're still going to restore the plan, which is important
Yes.
for your obligations.
Yes. And so, in addition to the motion and the second, just having captured this latter part of the discussion on audio, is that enough to have demonstrated our thoughtfulness in this area? Okay. All right, so we have a motion, motion and a second. Any other discussion? Trustee Horowitz.
And in view of that, it does occur to me that 3% is both higher than the CPI has been over the past years and likely will be over the coming years, certainly more than the average person would have earned in any reasonable investment or money market account. So 3% strikes me as slightly punitive. Perhaps the interest rate should be something closer to the CPI or 2%. It won't make a huge amount. What will make a big difference is extending the term of the payments. And insofar as this was not the fault of Mr. Honig at all, I think it might be just that he not pay 3%, but something closer to 2%, even though, yes, the plan would be absorbing that difference in terms of what we might have earned on the plan assets. So I would propose a friendly amendment that the term be doubled, but that the interest rate be 2%.
Yeah, I reframe my motion then to 140-month repayment period at a 2% interest rate.
I'll resecond.
Exactly.
Counsel?
That's way,
Notwithstanding the laudable intentions of the board members, the fact is that any underpayment of unfunded liability, which this is create an unfunded liability, accrues in the plan at the actuarial rate
Sure,
of
sure.
return
sure.
that we've been setting it at. So the interest is really the actuarial rate of return over the period of non-payment, and that will have to be reflected in the financial statements, and, I mean, it's not gonna show up.
Yeah.
But the actuary would tell you that, that is the interest rate that will be recorded, and the needle will move on the unfunded liability slightly at that rate, not at a 2 or 3% rate. So
Understood.
if the board is not going to be collecting the interest from the member in this regards, you may remain silent on the interest matter in the motion, because it will already be reflected in the books at the actuarial rate of return.
But the last part confused me.
Yes,
Yeah, I'm
yeah.
confused, I'm sorry.
So just to make this last less long, my motion was made fully aware and understanding that the UAL will increase, and that my determination, it is so de minimis and negligible that we are not breaching any duties of care or trust. The last piece you said makes no sense to me. If we're charging it, then he's paying it, so that's all, the 2%. We're adding 2% to the principal amount.
Oh, to the member.
Yeah.
Correct.
Oh.
The member was gonna do 2%, and I guess we
I
picked
see.
up the
I'm sorry.
1%
Yeah.
unfunded. That
Or
is-
it's even more than that, but yes.
Or whatever it is, if it's
Yeah.
6 point.
Then forgive me, I didn't understand the
okay.
motion.
Yeah.
And the interest will be calculated the way staff has calculated it already, but at a
2%.
2% rate for the entire 140-month term.
Yes.
Go-
Because-
Yeah, 140.
Because well, I believe, since I made the motion, and trustee Jennings, since she seconded, we'll soon find out if our fellow trustees agree. We believe that the the term extension is much more valuable to Mr. Horning, so he can make monthly payments that, within his budget, and that the interest is tiny and you're not gonna really feel it or see it. So that's why, and we felt that since we do have some obligation to think about that, we'll make it commensurate with what we think the CPI is roughly right now.
Just a
Lower it some.
just a question from staff. Go ahead, go ahead.
I'm just thinking, could you just re-clarify the interest, but you're not really going to feel it or see it, because Mr. Horning still has to bear the interest.
Sure, but it's spread out over 140 payments, so his monthly payment,
So
it was
it's
$30 or something like that to
amortizing
begin with,
for-
yeah. Amortized probably 15 or 16. And please don't hold me to my math, I'm
I
doing
see.
that off the
No,
top of my head.
Actually,
get your point.
29, 47, but $30 is close enough. No, a question for staff, just to make sure that we're clear. The motion have to do with the 140 payments, extending it. I just want to be clear, there's still the matter of the 3 payments in
Correct.
February, March, and April.
Yeah.
And do we want to collect those as stated there, because there's no interest, and then start the interest on May 1st for the 140 days? Is that, I just want to make sure that the
That's what
motion
I-
is.
That
not
was
co-
what I was proposing.
Okay, okay.
So maybe make that clear so he understands it.
Oh, I know, he understood that, I just.
Did you?
No?
Yeah, I don't think he did.
So does he has this information, the letter?
Or this,
Can you bring page 2 out of 4, please, at the beginning? Okay, do you see there are, what the board is recommending is the payment in the bottom, which is from May 1st, 2020 to February 1st, 2026 at $1,225.46. They are extending that pay period from 70 months to 140, thereby making it closer to the $500 that you indicated. But there's still the matter of the first 3 months, starting the next month, February 1st, a payment due of $885.69, on March, $946.78, and in April, $711.22. So the motion right now is to make those 3 payments as stated there, and then starting on May 1st, extending that to 140 payments, which make that payment down from 125.46 to somewhere in the $565 vicinity on a monthly basis. That's the motion.
So there's no way to roll it all into one, so I can just be making the payment? Because it's still
first 3
gonna,
payments be made,
thousand
they don't
months
need to be
would
made
go.
until May, right?
No, they need to be made in February,
Oh, they have to do
March,
February
and
1st, okay.
and they don't have any
They're painful upfront.
interest due.
Yeah, then those are painful upfront.
I'm sure,
Can
I
we
mean,
roll- Can
roll
we,
that
can we
into
roll
interest
them?
we can roll that into it, but then you start making the payments in February. We'll start doing it, but we will not wait until May for the payments. We'll start sooner, but then we have to add those 3 amounts, so it will be a little larger, but that's all. It will still be 140 months.
You'll start
that would be
paying.
best for me.
Okay.
Yeah, we
Okay.
can
Let's
do
do
that.
that, yeah.
We certainly can do that. Council, do you have any problem with that?
As long as I'm not doing the math.
Yes. Okay, so it's still, just to be clear, is the full amount plus those 3 months over 140 months at 2%.
Yes.
Thank you.
That is the motion, starting
Yes,
February
starting
1st.
next month.
Yes.
Okay.
And they will deduct it from my retirement check? Okay.
All right.
I think we're ready to.
One more question for council. So we're proposing making a significant change in the term. Is there any concern that we are establishing a precedent that that we're going to have to live by with other retirees in the same situation?
I like
What
to
say you?
say every member's interests are unique, And I would say there's no precedent here. I think the only precedent is that you've given due deliberation to the facts and the law and have made a judgment exercising sound discretion. That's the precedent that you've set. On the specific facts, each member's facts are going to be different. In my experience with San Jose, I haven't seen one of these before. I don't know if staff has one like this with a workers' comp offset that was so contested and confused in the information. Part of the problem is that workers' comp does not communicate with the Office of Retirement Services when these things come up. So it's very difficult for us to get, it's the same problem we had with the city's payroll and finance issues. You know, we went through, I'm going to editorialize for a minute, we went through a lengthy period where there were layoffs in the city and they were understaffed in the payroll department, and they didn't pay attention to the accuracy of stuff that was being reported to the retirement board. And so we got into a lot of trouble because of that. If we are mandatorily required to offset workers' comp payments for the same period that we're granting the disability retirement, we need the information from the city, and we need to have a pipeline and a conversation whereby the city provides that data in a timely manner to us so these things don't hang out for 5 or 6 years. So that's the real issue here, is that we need to tighten up the communication, because our fund depends upon communication that we get from the various city departments and from workers' comp. And I haven't seen this before, but this is an example of where that communication fell down, so.
So I'm just curious, Barbara, you know, since you're in retirement services, right? Communication is always at risk, you know, in making things smooth. I run into it all the time. And has something been changed in the process, or?
Yeah, Catherine, the benefits manager, can address that question, and certainly there has been a channel of communication with our third-party vendor, Intercare, which is the workers' compensation vendor that's in place at the minute. In this time period, it was actually the city of San Jose that was taking care of the administration of workers' comp.
They were doing it themselves at that point.
And then it got outsourced to Intercare. And Intercare, on our recent workers' compensation / disability retirement cases, has been very prompt in getting
Okay,
us
so
the
they're much
numbers.
better.
Because it does happen. We just went through one recently, but we had all of the numbers that we needed prior.
To catch it.
And certainly ORS has taken lessons learned from this experience and are seeking the information and opening up those communication channels.
That's good. I mean, that's all you can do, is move forward, you know?
Okay, are we ready for a vote on this one?
So I under
you
the
understand
understanding of this is gonna go down a little bit, because it says 3% interest, so when it goes to 2, it's gonna be a little bit less?
Yes.
That's correct.
Okay.
And the first 3 lines
Okay.
within that box, that's all going to be rolled together. So those first 3 numbers will go down. I don't know
Okay.
to the extent.
Can I just ask of Catherine, increasing the period to 140 months, is that going to impact the interest that's actually charged?
Will it
It-
change the total interest?
Yeah,
Absolutely.
sure, it'll
because
be
we're
more.
changing
It
interest
will
rate
increase.
and the
Yeah.
length.
Okay, I just want that
Sure, yeah.
very, very clear.
Yeah, no, the total amount of interest paid will increase.
Because the loan period is
Yes,
longer.
yeah,
Okay.
Correct. Good clarification.
So do we have a roundabout number that he, you know, like in February, so he's not like,
We are going to make sure that he gets all the information he needs to be clear on what the amount is due and how much
Okay.
he's gonna be paying on a monthly basis, right?
No, absolutely. Danny and I have had
Thank
pretty
you.
good communication through the last year with each other, and I will get the worksheets out to him as soon as I redo them.
okay.
Cool. Thank you.
Okay.
Is staff clear on the motion? Yes. Very well, thank you. I'll just, yeah.
All right, with that, all in favor?
Aye.
Aye.
Any opposed? Okay, that one carries. Mr. Horny, best wishes to you.
Thank you.
Ms. Schaefer,
luck.
thank you very much. Okay, Mr. Liederman, would you Is it possible to do the fiduciary training at the February meeting on your calendar? I'm sorry, I'm trying to,
Could we extend it 140 months?
Yes, yes. I second that.
Are we paying the interest on that?
Well,
I thought
we could do it today. I do need to go catch my train, but I'd rather be here with everybody
What
hearing the
time's
same
the train?
information at the same time.
what time's the train? What time do you need a hard stop?
I need to go downstairs, hop in my car, 11:35, 11:40.
I can't do it in 14
Yeah, yeah,
minutes.
I know.
but No,
The last
I do,
conversation
I do have one problem, which is I am currently scheduled to be at the National Association of Public Pension Attorneys Conference that overlaps the next Federated meeting.
Well, I think you've done fiduciary training for everyone here.
Right.
Except for trustee Jennings and Mr. Kelleher.
And Mr. Horowitz.
Oh, okay.
I believe. So what we could do is go back to the practice that I had done previously and just we'll come up with a date
Yeah.
and I'll meet with the three of them and go over the fundamentals here and then we'll just stay on our regular course. Happy to do that.
Okay.
Perfectly fine.
Mr. Chair, I really would like council to make a presentation to your board. I think it's always helpful to remind everyone about what those responsibilities are, so I would prefer that your board consider, even if it meets with the trustees individually, that we either on the annual basis or every 2 years have this presentation. I think it's always helpful to remind everyone what those responsibilities are.
Yeah, absolutely. I
So
agree.
No,
let's do
I
that.
think the last time it was September, maybe?
He
I
did
can't
it.
remember. So I do it annually
Okay.
with the
He did it in
board.
2019.
We
Okay,
can
so-
certainly do, we
all right.
can certainly do that as well. I will say, because I'm very impressed, and what you just went through
No.
is a perfect example of good fiduciary practices. You had, you're not a guarantor of any outcome. You are a guarantor of a fair and open process and an educated process. You had the material in front of you, you had the data, you had staff be able to explain, you had counsel explain the law. We made a good record. You exercised your judgment in a sound manner. That's it. I mean, that's the training. You just trained yourselves. And so, of course, there's more that I would give you, but if you just take to heart the process that you went through and the judgment that you exercised with the data in front of you and made a good record, because this is being recorded and will be in the minutes, that's what good fiduciaries do and good trustees do. So I applaud the process that you've been through this morning.
Thank you.
Well
Thank you
done.
very much. Great job, team.
Yes, I was gonna say.
Okay, so 5F, we're going to move on without that one. And then, let's see, and then next we will go to item 6, committees, reports, and recommendations. Investment Committee,
Yeah, so we didn't meet in December. Next to no agenda, it didn't make sense, inefficient, but we are meeting on Tuesday, this coming Tuesday. So that is for trustee Orr and trustee Sun to put on their calendars. And we've moved the meeting time to noon, if I remember correctly, right? Prabhu? Okay, because there is no joint. The the police and fire decided they didn't need a meeting in January. So we'll just be meeting alone, noon, over at ORS on North First Street. And it's not a long agenda. It shouldn't be a long meeting.
okay, thank you. 6.2, Governance Committee, trustee Orr, anything to report here? Okay, Audit Committee, last meeting was October 17th, and we've got a meeting coming up in February. 6.4, JPC,
We are just going to be scheduling a meeting for next week, October 30th, and those of you who indicated that are available, please make sure to attend because we need you for a quorum. We already know there are 2 trustees, one from Fed and one from police that are not available.
very good, thank you.
For,
JPC next week on the 30th at 10 a.m.
who's not available?
Trustee Orr is not available
Yeah.
from us,
Yeah.
and trustee Sanseri is not available,
Okay.
so.
Okay. Item 7, education and training. We have the Cortex report, Calipers program calendar, Calipers General Assembly, Calipers advanced principles, okay, very good. SACRS, spring conference, UC Berkeley, and SACRS fall conference. Do city plans go to the SACRS?
Not
That's,
usually. SACRS, that stand for the State Association of County Retirement Systems, which are the 1937 Act counties, but there are some other plans that participate from time to time, and City of San Jose is one of them, and the City of San Luis Obispo, and City of Fresno. We participate from time to time on those, but not usually. We do not attend usually. In fact, I cannot usually attend those meetings because I have board meetings on Thursdays. So if I go, it will only be for a day and a half when they're nearby.
Okay.
But they are, if you have time, I think those two and the Calipers annual assembly, general assembly, this time is going to be in Las Palmas Resort Rancho Mirage from March 7th to the 10th. I strongly suggest that you consider attending that one. As you know, I'm a member director with the Board of Calipers, and we make a lot of effort to make sure that it's a very helpful assembly. So I would recommend, if you have the time, to attend one of those in the future as well.
Yes. Okay, any future agenda items? Public retiree comments? We're adjourned. Thank you, everybody.